Okay. Good morning, students. We are recovering today the last topic. Today is the sixth day, and I'll be covering the topic basically forward fate of forward contracts, and then nose through, was through accounts. And last time we have done options, and I thought I'll start with the question which I did last time, so that I can just again brief you about this question. There's a small mistake which I committed, so I'm just going to correct that also. So this is basically an exercise one of options. Okay, XYZ Limited, this is a US firm, will need 3 lakh pounds in 180 days. So in this case, they are going to actually need 3 lakh pounds. So that means they're going to pay 3 lakh pounds. But inadvertently, I said they are going to receive in my last video. So they are going to actually pay the US firm is going to pay pound 3 lakhs, okay, in 180 days. So in this connection, the following information is available. The spot rate is given, which is, 1 pound is equal to $2, and 180 days forward rate of pound as of today is $1.96. Now, the firm has an exposure in pounds, okay, and it's a US firm. Eventually, they will pay pounds, which will be converted for them into US dollars, and they would like to know, how much they are paying. So, as you can see, they have an exposure in pounds, and if the pounds, appreciate, they are going to pay more, okay? And if the pound depreciates, they pay less, okay, because they are importer. And as we can see, 180 days forward rate is suggesting that the pound is depreciating. So that's a good thing for the company. From the spot, it is moving from $2 to 1.96 per pound. Okay. So the interest rates are given for deposit rate as well as borrowing rates are given. Then, and the section which I'm going to explain again is the call option. Okay. The money market hedge we have already covered in my last video. So I'm going to just stress on the call option. Now, since the exposure is in pounds, so they are going to take a position, since they're importers. So they are short in pounds in their underlying position. So they are going to take opposite position. They are going to, buy a call option. That means they are going to take a long position in the call option. So which means if the dollar appreciates, the pound appreciates, position, so they get money here, okay, in the stock, options contract with the stock exchange. But correspondingly, they are going to lose money in their real transaction because they have to pay at a higher price. Okay, so that means there will be two kinds of, there will be a loss from one place and a gain from another place. So gain, they are hoping to get a gain in the stock market, and that will get it offset against the real underlying position, or it can be a vice versa. So they have taken a call option on pound. Okay, so these quotes are direct. So that's why a call option on pound, because they are exposed in pounds. So this is going to expire 180 days as an exercise price of $1.97. Okay, so that means the exercise price is also given. It is 1.97. Okay, and they're going to pay a premium of 0.04. Since the spot rate is given as $2 and here the strike price is 1.97. Okay, so this is close to the money, or maybe slightly in the money. Okay, because they will start making money if the pound goes past 1.97. But first they have to cover the premium. So if we add the premium to the strike price, it comes to 2.01. So that means if the pound moves and closes above 2.01, they're going to exercise the call. But if the pound moves below 1.97, they are not going to exercise the call. But any move above 1.97, it will actually fetch them the premium till the extent of 2.01. And after that, they'll start making profit on their option position. And the profit which they are going to make will actually offset the losses which they are going to face at the spot rate when they are going to pay 3 lakh pound on their underlying position. So I'll just, take you to the now. If you look at the forward contract, then they were paying 5,88,000 dollars because it was 3 lakh pound and the forward rate is $1.96. Okay, so that means this was their outflow in terms of dollars when they took the forward cover. Then, I explained the money market hedge. You can refer to my earlier video. That was the last video. So there you can see their outflow was, the last box, their outflow was $6,05,740. So in fact, they're finding that they're paying more, okay, compared to the forward transaction. So now let's go to the call option. Okay, so here the call option on pound that expires in 180 days has an exercise price of $1.97. Okay, and a premium of 0.04. Now, there is in the question it is given, so I can just take you to the question. I think I missed some part of it there, so I'm just going to cover that. So what they say is that XY Limited has forecasted the spot rates at 180 days, which is like the future rate, which will be there the 180 days are over. That would be the spot rate. They're expecting that the chances are that will be 1.91, 1.95, and $2.05. And their respective probabilities are also given. So there is a 25% chance that it will be at 1.91, 60% chance it will be 1.95, and 15% chance that it will be 2.05. Now, which of the following strategies would be more preferable to the company? A forward contract, a money market hedge, an options contract, or no hedging? So we have to show the calculation. So forward contract we have already seen. Money market also we have seen what will be the likely outflow in terms of dollars. And then we are going to talk about options contract and no hedging. Okay. So let's go back and see what is the position if there is the company goes for a call option. Now these quotes are actually direct in nature, so we can just take a call option. Basically, if the call option expires in the money, then the company will be making profit from the hedging position. So in this case they've taken a call option where the premium is 0.04. Okay, so that means their total cost would be 2.01. So now let's talk about first scenario where the expected spot rate is 1.91. Okay, this is given the question, and the premium is 0.04. So in this case, since the call has expired below the spot rate, below the strike price, so they're not going to exercise the call. They'll be very happy because they have to pay very less money when they have to make the payment in the to the bankers. Okay, because the spot rate has gone down to 1.91, but they would not be exercising the option because it has actually gone worthless. So they're not making because they're going to not exercise the call and call option, and the premium plus the strike price would become their cost of hedging. Now if we convert that into dollars, it comes to 5,85,000, and there is a 25 possibility of this scenario. So as per pro rata basis, it will be 1,46,250. But the second is that they are going to if the expected spot rate is say 1.95 dollar per pound, so still it is below the strike price or the exercise price. So they're not going to exercise the option, and they'll be very happy to pay less to the bankers when the money becomes due, and the bankers will ask them the money. So it will be 1.95. For that, of course, the probability is 60%. So that means the cost of hedging would be 1.95 plus 0.04. So that means they're not going to exercise the call option. So they're going to the total cost will be 1.99. So which translates into in terms of dollar 5,97,000. Okay, and probability 60%. So equivalent amount will be 3,58,000. Okay, so then the third probability is that the pound is going to appreciate. Okay, if the pound appreciate, which means that the company has to pay more in their real underlying position. So now, since it has moved up and they have bought a call option, so they are going to immediately exercise the option. Okay, and they are going to make a gain of 2.01. That means they are going to have their cost of their hedging price will be 2.01. how it has been calculated, I'll just show you that. So it is basically, if you look at the screen, gain on the option contract. So, the strike price was 2.05 and sorry, the price at which it is going to close is 2.05 and strike price is $1.97 and premium is 1.04. So, which means that the total gain on the option contract will be 0.04. So, which means that, they will be actually, receiving their payment at 2.05, okay, and and it has closed at 1.97. So minus the premium, so the net outflow would be basically, so gain is 0.04. So this is the difference between the strike price and the at which the call expired. So call expired at 2.05 and they had taken a strike price of 1.97. So they are making a profit of 2.05 minus 1.97, which comes to about 8, $8, this thing, minus a 0.04 premium. Okay. So which eventually will mean that their gain will be 0.04. Okay. Premium per dollar. So that means this much $0.04 per pound they are going to make money. Okay. So which is, if we, the net outflow, if you look at the bottom of the screen, the net outflow, when they go to the bank will ask them 2.05, because what has happened, that the dollar pound has appreciated 2.05 on the due date. They have to make a payment of 2.05, at that rate. But they have made a gain of 0.014 in the stock market. So eventually, their net outflow will be at $2.01 per pound. Okay. So which means, so I'm just going to make it back to, full slideshow because I was not able to see. So that means the total outflow will be, in terms of dollar, it will be 6,03,000. Then converted into pound, the figure has been shown there. So the total outflow, if we add all the numbers, it will be 5,94,900. Now they need to add the interest on the premium because the premium is paid upfront, and at the expiry, it will get adjusted. So that money will remain blocked of the company. So it is interest will be 5.5%, which is given in the question. Okay. So we are going to apply that 5% on $12,000. How we have worked at $12,000? It is, 3 lakh pounds into 0.04 is a premium per dollar per this thing per pound. So we multiply it and we get, total amount in terms of dollar will be 12,000. So that means they are given 12,000. The call option buyer has given $12,000 to the call writer. So that money has been paid upfront. So at that, we are going to add 5.5% interest for 180 days. So that comes to $660. So overall, the outflow will be 5.95560. Okay. So if we, divide this by the 3 lakh pound, so eventually, actually, they are paying at $1.98 per pound. So now, if you just look at the no hedge strategy, where we just take the future spot rate as per the expectation of the company, and then we multiply it with pounds, and then apply the respective probability, we'll get the dollar amount. Okay, fine. So which means that total outflow will be 5,86,500. So how it has been worked out? No strategy. That means we are just going to, the company is not taking any hedging positions. So based on the probability of scenario, so at what rate that pound is going to get closed at after 180 days. So we have taken this thing, and then we have multiplied and converted them into dollars at 3 lakh pound multiplied by 1.91. So it gives you 5,73,000.25. It gives you the expected dollar flow for this respective probability. So if we just add them, so we get 5,86,500. Now let's look at all the options. So this is very important chart, and we must focus. So the forward contract rate, we found they were paying 5,88,000, and the total exposure was 3 lakh pounds, and it comes to 1.96 per pound. So this was the forward rate which was given in the question. Okay, so this was the kind of cost they were bearing if they would have taken a forward cover. If they have taken a money market option, which was not going in their favor, so they had to pay $6,05,741. So if you divide this by 3 lakh pound, so it comes to 2.02 pound dollar per pound. So this was the costliest option to go for money market. But when they had gone for a currency option, their total outflow was 5,95,560. We just calculated that. So if you divide this by pounds, so that means their total cost of hedging was they were achieving this 1.98 pound per dollar per pound. So which means which is a little higher than the forward rate so far. But if you look at the no hedge, which is we just calculated, it's 5,86,505. If you divide this by 3 lakh pound, we found it was 1.955. Now, if you look at all these options, then you find if they don't hedge, they are actually incurring less cost, which is the least cost, which is $1.95 per pound. So they will always go for no hedge position. Okay, so no hedge strategy appears to be the most preferable because the least number of dollars are needed under this option to arrange 3 lakh pound. So I hope you have followed. Then I'm just going to close this and stop this thing and just see, because I'm not able to see your chat box at the moment. So I'm going to see. Yeah, so I get these are this thing. Good morning, Tanisha, Charish, Mane, Satish Kumar, Namrata. Namrata is there. Mansha is there. Good morning, Mansha. Good morning, Namrata. Now, if you have any issue or anything which you have not followed, you can ask me a question. Okay. So let me just go back to the. So let me just start with the fate of forward contracts. Okay. So I'm just opening my slide. So this is fate of forward contracts. I'm going to share my slide now. So I think you can see my slide now. Okay. So this is, another chapter. So in the meantime, if you have any query, you can ask me. Sir, please can you solve on the board? Yeah, I'll do that, Namrata, definitely. Since I have already done, on the last class, so this was just a repetition of what I have done. So maybe at the fag end, I may just go on the board and I try to explain this again. Okay, fine. So don't worry about that. So now, since we have two more topics today to cover, so I'll come back to that question again and keep ready your queries, okay, so that I can answer them. So fate of forward contracts. Generally, whenever we take a forward contract from the bankers, whether we are exporter or an importer, okay. So what happens to those forward contracts? How they are dealt with? So there can be delivery. The first scenario is that there is a delivery under the contract. Okay. So that means if we have taken a forward contract to purchase dollars or any other currency on that day, we purchased those dollars, we took the delivery of the dollars from the bank and paid them in Indian rupees. Suppose it's happening between Indian rupees and the foreign currency, say dollar, for example. So we would be, paying the dollars to the import when we are importing, and we will be giving rupee to the bank. Okay, so the delivery under the contract. So cancellation of the contract. So sometimes it may happen that we don't require the contract. We have already taken a contract, and because our import or export order got cancelled, and we need to even cancel the corresponding forward contract for the bank. Then it may happen that we need to go for extension of the contract, because the importer is if we are importer, so we are not able to import the goods in time. So and even the credit period will also go forward. So we need to extend the contract. And similarly, when we are going to receive money from abroad in terms of our exports, so it may happen that the exporter has not shipped the goods in time. So we will require more time to so in that case, we would suppose we are an exporter and we have taken some time to more time to ship the goods to abroad. So we may like to extend the contract. Okay, because our customer would pay the money little later than what it was, earlier decided. Okay. So first is delivery. Now, delivery can happen on the due date. Okay. Or you can have an early delivery. So what happens means that, if we have, take a forward cover for our exports, okay, and our customer wants to pay immediately. I mean, of course, we have given, we have given them time of 3 months, but he's ready to pay after 2 months. So there can be an early delivery also of our, emittance from outside. Okay. And then there can be a late delivery also, which means that, our exporter would take when we are exporting, our customer will take some more time than what it was originally envisaged. So, but we have taken a forward cover for that date. So we may need to, make some changes with the bank. So that is called the late delivery. So again, cancellation can happen on the due date. So we just came to know on the due date that we don't require this contract. So we may go and cancel it. Then there can be an early cancellation. We have taken a 3-month forward contract with the bank and we realize that we don't require that. And we realized, say, after 2 months or after 1 month, so we may go for early cancellation with the bank. Then it can be a late cancellation also. That means, now the due date is over and, we require that the underlying export or import transaction is not going to happen. And we realize it quite late. So we went to the bank and asked them to cancel the contract. Okay. So similarly, extension also can be, there can be three scenarios, extension on due date. So on the very date on which we are going to, make the payment or receive the payment, we went to the bank and, we said that and there is some delay. So we need to, extend the due date of our forward contract. Okay. And then can be an early extension also. So we go, before that only, we go to the bank and seek for early extension of the contract because of some unforeseen circumstances, our, import or export transactions are getting delayed. So we may go for an early extension. So we came to know much before the due date. The last is late extension. So we didn't have much information. So we, went to the bank late after the due date is over. So we sought for a late, extension that we need the forward cover for buying dollars or for receiving the dollars. Now this is going to happen at a later date. So we went to the bank for extension of the contract. So now let's talk about the first question, which is delivery on due date. On 1st of January 2024, the bank enters a forward contract. Okay. Bank enters a forward contract for 2 months for selling US dollars at the rate of 83.25. So on 1st January, you enter for selling your US dollar. That means you're an exporter. So you're going to get $1 lakh after 2 months. So you took a forward contract at 83.25. On 1st of February 2024, the spot rate was 83.550. That means after the 2 months, whole of January and then, February. So it happened that it was 83.55. Calculate the amount to be debited on the customer account. So January. So maybe that, it should be, 1st of March. If I've just made a mistake, our 2 months are going to, be there after the March. Okay. So we have January full, February full, and 1st of March. So that means it will synchronize with my, information. So calculate the amount to be debited to customer's account. So now, since you have taken a forward cover, okay, and you are basically, selling US dollars. So that means, so a bank enters into forward contract for selling US dollars. So that means you are an importer. So bank is selling US dollar to you. Okay, not you're an exporter. Here the bank is selling US dollar to you. So you are importing goods from abroad, and bank you have gone to the bank and you need $1 lakh. Okay, so they are selling you the US dollars. So the bank will apply the original rate, which is 83.25, and will debit your account of the customer with rupees 83,25,000. Which is 1 lakh multiplied by 83.25. Since you're going to go to the bank and purchase these dollars because they're an importer, so the price is 83.25. So you have to pay 1 lakh into 83 points. So this is simple. Next question I'm going to solve on the board. Okay. So let's look at this question, early delivery. So let's understand some theory behind it, and then we go and solve this question. Bank may accept the request of the customer of early delivery before due date of the contract. provided the customer is ready to bear the loss, if any, that may accrue to the bank as a result of this. So since you're going and you're receiving money earlier than what it was expected, so maybe the foreign exchange rates have changed and there would be some loss to you, and that loss will be passed on to you by the bank. In addition to some prescribed fixed charges, bank may also charge additional charges comprising of, now these are two very important terms. Additional charges will be swap difference and interest on outlay of funds. So these are the two charges which the bank is going to charge from you in case if there is a loss on account of this swap difference and interest on outlay of funds. So what is swap gain or loss? Swap gain or loss is the difference between the two new contracts. You know, when you approach to the bank and the bank has, you know, suppose you were a exporter, so you have actually, you know, you are going to get dollars, so you enter into a forward contract to sell dollars. Okay, so you sold the dollars and the bank immediately entered into a covered contract with the interbank market to basically buy those dollars, sell those dollars in the interbank market to dispose of those interbanks. So the bank is always entering into two kinds of transaction. One, they are giving, you know, dollars to you, and then they are buying those dollars from the interbank market at the same time and giving the dollars to you. Okay, so now those contract needs to be cancelled. You used to cancel the original contract with the customer and the covered contract in the interbank market. So they entered in the two contracts when you had gone for taking a forward cover. So they're going to cancel those two contracts. And if there is any loss or gain on because of this, they're going to recover from you. And it might be also possible. Now, the second one was outlay of funds. It might be possible. Now, all these things will be understand when we do a question. So please go through the theory first. And then when I explain, you may find that it was an easy thing and you can relate to this theory. It might be possible early delivery request of the customer may result in outlay of funds. So, you know, bank may have to spend money before, you know, early, as they were, you know, earlier it was, you know, at a time when your contract was, you know, maturing, but now they have to, the outlay happened to be earlier than what it was thought of. In such case, bank shall charge from the customer at a rate not less than the prime lending rate for the period of early delivery to the original due date. Nowadays, you know, the prime lending rate is not there, so we have a base rate and MCLR rates. Okay, so however, but anyway, I mean, it's the rate of interest which the bank charges. So now, you know, the era of prime lending rate is over. So we have base rates and the marginal cost lending rates which the bank charges from their customers. However, if there is an inflow of funds, the bank at its discretion may pass the interest to the customer at the rate applicable to them. Okay, fine. So if there is any earning because of that, you know, then they will pass on this benefit to the customer. Otherwise, there is a loss, they're going to recover. Okay, so let's do a question so that you can this thing. So I'm going to, you know, solve this question on the board. Okay, so first let me just read the question and then I'll, you know, go to the board and solve this question. On 1st of October 2015, Mr. X, an exporter, enters into a forward contract with BNP Bank to sell US dollars 1 lakh on 31st December 2015 at rupees 65.40. So you are basically a exporter. So on 1st of October 2015, he enters into a forward contract with a bank to sell $1 lakh because you're going to get dollars. So you're going to, you know, go to the bank and sell these dollars. And the date on which you're going to get dollars is 31st of December 2015. So the bank agreed to, give you 65.40, okay, at the time when you're going to give the dollars to them, that is 31st of December. However, due to request of the importer, Mr. X received the amount on 28th of December 2015. Okay, fine. So that means instead of receiving the money on 31st of December, you received the money on 28th of November 2015. So X requested the bank, he requested to the bank to take the delivery of remittance on 30th November 2015 before the due date. Okay. So the interbank rates on 28th November 2015 was as follows. This was the spot rate, which is 65.22, which is the bid rate, and 65.27, which is the ask rate. Now the customer is going to he has received dollars. So the 65.22 bid rate will become applicable here. And 1 month premium is also given, which is 10 swap points oblique 15. Okay. So if the bank agrees to take the delivery, then what will be the net inflow to Mr. X, assuming that the lending rate is 18%. Okay. So I'm just going to get up the board and explain that. So let me know if you can see the board now. Good morning, Viraj. Yeah. So I'm just going to adjust my camera. Okay. And see if you can. So, yeah. Just going to open my slide also at the same time. So basically, how do we solve it? That so let's look at the original contracts. So first, let's look at the original contracts, which the bank, the customer had with the bank. Hope you can see me on the board. So let me just check that if whatever I'm writing, is it visible? Yeah, I think it is quite visible. Yeah. So let me just go back to the question. So first, what happened was the first part of this thing was there was a forward contract. I'm going to use a different pen. So a forward contract. So you took a forward contract, okay, or the forward contract with customer. With customer to buy dollars. To buy dollars. The first contract was this. That customer was an exporter and the rate was rupees 65.40. Fine. And the date was 31st 12 2015. Yeah. Which entered with you to buy dollars. Okay, so they're going to buy your dollars since you are an exporter. So you're going to get $1 lakh. Okay, so the question says that let me just look at the numbers. Yeah, so it is $1 lakh. Okay, you're going to receive, and you are an exporter. So you're going to receive $1 lakh when on I will just put that number here. So you're going to receive the dollars on 31st of December. Okay. So when you enter into this contract, so you're going to have a separate contract. This is called a covered contract. Okay. So this is covered contract. So you are going to, at the same time, when you're going to buy dollars, you're going to sell dollars in the interbank market. Covered contract, covered forward contract. So this is the second cover, forward to forward. So you're going to forward contract to sell dollars. To sell dollars in the interbank market. Okay. And the rate is not given, no problem. And this also you're going to do. You're going to sell these dollars in the forward market at the same day. So when you approach to the bank and you said that we are going to receive dollars, so you enter into a forward contract. Bank entered into the a forward contract with the customer to buy dollars. So since they have bought dollars, they're going to sell these dollars into the forward market, interbank market, so So they don't they have any exposure on themselves. So they've completed this transaction. So these are always when you enter in a transaction with the bank, they're going to enter into a covered contract also. But now what happens? Now this guy X, okay, who is an exporter, he received the amount early. He received this amount on 28th of November. Okay. Fine. 2015. So he requested the bank to take delivery on 30th of November. So delivery is going to happen 2 days after this day. Delivery is going to happen on 30th November 2015. Okay, fine. So so this was the thing. Now what the bank is going to do, they are going to enter now into a contract. So these are offsetting contracts. First, they have bought from the customer. Okay. So you know the on 28th November they are going to get the dollars. So they are going to sell these dollars in the interbank market immediately. Sell the dollars at spot rate. It is given in the question. So they are going to you know, since they have sold the contract to you at 65.4 and they're going to stick to this rate even on 28th of November 2015, so they are going to sell and they're going to you know, cover this. I mean, they're going to spell this at the spot rate. So where the rates are 65.22 oblique 65.27. Fine. So what rate will be applicable? The bid rate, because you're going to sell at the spot rate. So bank is going to sell. So bank is also going to sell at the spot rate. So and this is going to be 65.27. This rate. Then this is going to be which date? On 28th of November 2015. Okay. So this is the date when they're going to sell. Okay. So it can be either 30th or 28th. You can put even 30th or whatever you want. Okay. So they're going to sell it on 28th of November. Okay. These dollars which they received from the customer. Okay. So this takes care of the first contract. Right. So they bought the dollars at 65 and sold them at 65.22. Then they are going to enter into the fourth contract because this contract is still hanging, okay? Which they are going to sell. They are going to, I mean, what they are going to do? They are going to cover contract to sell dollars. So now they need to, you know, go for to buy the dollars. So they are going to buy the dollars. Okay. So this is basically to nullify the covered contract. So they're going to sell these in the interbank market. So we know that the rate which is given is 65.27, which is the spot rate, but 1 month forward rate is given to you, which is 15 paisa. So that means they're going to basically buy the dollars at 65.44. This plus this, it comes to 65.42. 65.42. Now,
Parvesh sir,
Ajit,
I think student has some issues in they are saying some it is not clear. Just check it. I think you need to sir.
okay, just let me check. They are not able to see the board.
No, board is visible, but I think you should write some in you are writing in a small font. No? That's why it is not maybe the visible.
It's a very big board, okay? So I don't know. I'll just check what is the query. So not properly visible. Okay, not properly visible, as you're saying. Okay, so what I'm going to do is that I'm going to just change my camera. Okay.
No, sir, camera is okay, I think. I
Achha.
think on the whiteboard when you are writing, it's use a black pen.
Acha.
Okay, you are using blue pen or black pen?
Okay, I'll use now the black pen. Okay.
And font should be more higher. Font should be on the higher side.
Okay.
Okay.
Sure. So I'm just going to put it again for your convenience. I'm going to use a so the question says, so let's begin again, okay, so that you can understand. So, on the question is on, so this now I'm writing on the black, okay. On 1st October 2015, okay, Mr. X, I hope now you are able to understand what I'm writing. Mr. X, who is an exporter, okay, he's an exporter. He enters into a forward contract with the bank. Okay, so he's going to sell dollars. Okay, how many dollars? $1 lakh. So he enters into a forward contract. The first contract which is going to enter the bank is this, the forward contract. So now, when he's going to receive his money, it is there in the question that he's going to receive the money on 31st of December 2015. So this is the date. This is the today's date, and this is the date on which they is going to receive the money. So he's going to enter into a forward contract, okay, or the bank is going to enter into a forward contract with the customer. Okay. So what will be this forward contract? To buy dollars. To buy dollars. To buy dollars. So this is the first contract which, the bank is going to enter the customer to buy dollars. Okay. How many dollars? $1 lakh. And the rate given by the bank is 65.40. So this is in rupees. Okay. And the date is on 31st of 12th, 2015. So this is the date on which the banks enters into a forward contract with the customer to buy their dollars, because the customer is an exporter. So he's going to get $1 lakh. So bank says, okay, we'll take your dollars and we'll buy your dollars from you. And the rate which we give you is 65.40. Now, since they have entered into this contract, they are going to have another contract, a forward contract, which will be a corresponding contract, which is called the covered contract. Okay, a covered forward contract. I'm writing the word FC, a covered forward contract. To now they have bought it, they need to sell these dollars. Okay, they're going to sell the US dollars, which is $1 lakh again. Okay, so they're going to sell these dollars. They're going to put it back. So they're going to sell these dollars, same dollars in the forward this called the forward market. And when they're going to do, so they are going to do it as they're going to sell the dollars. Now the rate is not given to us, but they are going to do it on same day. Okay, right? So this completes the transaction in the bank. They first bought the dollars from the customer, and now they are going to dispose of these dollars in the interbank market, in the forward market, and synchronize both the contracts so that they are happening on the same day, that is the 31st of December. Now, you know what happens? The customer comes to the bank and says that I have received early delivery. I'm going to receive now the money on 28th of November. So please, on this, take the delivery on 20th of this thing. Okay, so that means the bank is going to have some more contracts on, which is the date they're going to have on 28th of November 2015. Okay. So you went to the bank and said that you're going to receive the money on 28th of November 2015. Okay. So now they're going to sell the dollars. Since you have got, the bank has got the dollars with them from the customers. Are they saying the person is sending the dollars from abroad, the customer's supply. So he's going to sell these dollars. The bank is going to sell the dollars. Okay. Sell dollars. Sell the dollars at spot rate. Right. So because the bank has bought the the dollars from the customer, now they're going to sell at the spot rate on 28th of November, and the rate is being given as, so they're going to sell the dollars how much? 1 lakh again. Okay, and the rate has been given as, in the question it is given as 65.22, which is the bid rate, and the ask rate is 65.27. So these rates are given to you, and the bank is going to sell these dollars at this rate, 65.22. So they are going to sell dollars. Now they bought the dollars, and now they are going to sell the dollars. So this transaction will get nullified and will be taken care. Okay, but they have one more contract, which is the forward contract to sell dollars. So they have already sold in the forward market, so they need to even close this. Okay, so they're going to have another contract where they're going to close this transaction. So they're going to, see this covered contract. So this needs to be closed. Okay, so covered contract to buy dollars. So now, since they are sold, now they're going to buy dollars. They're going to buy dollars. So they're sold, now they're going to buy dollars. When? On 30th, of 31st December. At what rate? Now the rate is given, that the rate is 65.22 oblique 65.27, and the bid and ask points are also given, which is 10 and 15. Okay, so we are going to look at this point. So they are going to, bank is going to buy, so the ask rate will be applicable. Okay, so this will become 65.42. Okay, so the bank is going to sell these, buy these dollars at 65.42. So what happens is, now this transaction has got nullified because of this transaction. They have first bought, they have bought, then they sold initially, and then the third and the fourth contract are actually taking care of reversing both the contracts which they have entered earlier. Okay, so what will happen? So I'll just explain now on my slide, since you have understood. So I'm just going to put my slide on and show you on my slide. So just look at this slide. Are you able to see the slide? Let me just check. So now visible. Okay, Namrata is saying, and black pen. Okay, I'm using now a black pen. Okay, and why the bank in convert in forward market? Okay, fine. So I explained that, Namrata, in my earlier videos. So please go through the videos which I've already shared. So look at this, one by one. Okay. Now, this was the first contract, the forward contract with the customer to buy dollars. What rate? 65.40 per dollar. So the customer is going to receive money on 31st of December 2015. So the bank said, okay, we'll buy dollars from you, okay, and give you Indian rupees because you're going to get $1 lakh from your customer. So this is the first contract, and then the bank is going, when the bank has received dollars, they're going to sell these dollars. They're not going to keep dollars with them. Okay. So they're going to go to the interbank market and dispose of these dollars. And such kind of a transaction is called covered forward contract in the interbank market to sell dollars. So on the same day, they are going to have two transactions, one with a customer. Second, when they receive dollars, they're going to sell these dollars in the interbank market so that they don't have any exposure in the dollars. Okay. Otherwise, if they keep the dollars and the dollar depreciate, then they're going to lose money. Okay. So they just close these positions immediately or the earliest so that they don't have any exposure in the foreign currency themselves. So that's it. So on X, now X, received amount on 28th of November 2015. So Mr. X requested the bank to take delivery of the remittance on 30th of November. So what happened that you got an early delivery of money coming from your customer. So instead of, the customer, instead of paying on December, he has sent the money on 30th of November or 28th of November. So now you've gone to the bank and said, okay, I'm going to receive dollars. So please take the delivery of these dollars and give me Indian rupees. So there will be two new offsetting contracts which the bank is going to enter. First, they are going to sell the dollars because now they have received the dollars from the customer and they have paid him. They have paid him 65.40, which is written here. So they are going to now sell these dollars. So this first contract will get offset with a third contract. So they are going to sell these dollars. Okay. So when they sell these dollars, they are going to get the bid rate, which is 65.22. Okay. Then at the same time, because this second contract to sell dollars in the forward market, which is still there with the bank, so that is going to happen on 31st of December. So this contract is still in existence. So bank would like to take a reverse action. So they are going to enter into to buy the dollars. So they have sold the dollars. So now they are going to buy. So the second contract and the fourth contract is going to close the covered forward contract. So which means that the forward, they are going to do on due date is 31st of December. So this transaction is going to happen on 31st December. So they're going to have another transaction which is going to, where the due date is 31st December. Now they are going to sell, they're going to buy US dollars. Okay. Earlier they have sold, now they buy. Okay. And they buy at 65.27 plus 0.15. So that means they are going to buy the dollars at 65.42. So which will close this, the second transaction. Okay. So now, what is the swap difference? Now the bank has sold at the spot rate on 28th November at 65.22. We just did that. So if you go back, they have sold these dollars at 65.22. So I'm just putting the information here. Now the bank buys at a forward rate, which is 65.42, which is 65. This is basically cancellation of the original cover contract. So that means they have bought at 65.42. They have sold at 65.22. 65.22. So which means they have suffered a loss of $0.20. So on $1 lakh, it will come to 20,000. So $1 lakh multiplied by 0.2. So this is the cost which the customer has to bear. Okay. So they'll be charging this money from the customer. So now we come to the second part, interest on outlay of funds. Now it buys from the customer. Now, the customer came, and said that I'm getting the money early. So they buy it on 30th of November. So outflow of on 30th November instead of 31st of December. 31 days earlier than the agreed date. So what happened that the customer came and said, please, I've got the dollars and, convert that money into rupees and give me rupees. So the bank was supposed to do it on 31st December. Now they have done it on 30th. So they have done 31 days earlier than what it was agreed. But at the same time, the bank has also sold So this was first was outflow. So on 28th of November, the bank sells. So there is now inflow which is happening on 30th of November. Okay. So which is 65.22. So they dispose of these dollars because the dollar were received on 30th November. So that means the outlay of fund would be to the tune of $0.18. So they had to buy the dollars at 65.4 and they had to sell the dollars at 65.2. So there was an inflow and outflow happened with the bank on 30th of November. So which was, in terms of cash flow, it was 0.18 into 1 lakh. So that means 18,000, outflow has happened, to the bank. So bank is going to charge interest on outlay of funds, which is going to be 1 lakh into 31 days, 1 lakh into 0.18 into 31 into 3 divided by 365 into 18%. So they are going to recover 275 rupees from the customer. So net, what happens is that the charges for delivery will be swap loss 20,000, which will be recovered from the customer, interest 275. So that means the bank is going to, the customer is going to receive because the agreed rate is 65.40 into 1 lakh. So the bank customer is going to get 65 lakh 40,000, but there will be some charges leviable to the bank, which will be 20,275, which is the swap loss plus the interest on outlay of funds. So altogether, the customer is going to get a credit of 65 lakh 19,275. So this completes the question. So if you have any queries, please raise them. Okay, so that I can this thing. Okay, have you followed? Okay, so please first of all, should I explain it again? Because if you understand one question, then you can understand all the questions. Okay, fine. So let me know your view about it. Have you followed? So Namrata, is it clear now? Satya Prakash, I have used the black pen as you said. Tanisha, Mansha, Satish, S. Kumar, have you followed or is there any query? So please let me know. I'm just waiting for your responses. Clear, sir. Sailesh, wonderful. So what about others? What about others? So I should have one more good response where I can move to the next question. Okay, so I'm not getting any other response. I'm just going back to my screen now. Okay, so we'll do another question. Okay, so I'll revisit because I'm just seeing your questions, queries on the same system. So I have to just close and open one. So cancellation on due date. Now the second scenario will be there is a cancellation on the due date. So because you would like to cancel the contract because of some reasons, in case of cancellation on the due date, in addition to the flat charges, the difference between the contracted rate and the cancellation rate, reverse action of the original contract is charged from or paid to the customer. So since you have entered the forward contract, now you're canceling it. So you are going to have whatever contract you entered earlier. So there will be a reverse contract. So if you bought it, now you're going to sell. If you sold earlier, now you're going to buy, so that the contract is over. So if you are suffered a loss, the bank is going to charge from you. If there's any gain, so bank is going to pass on that gain to you. Okay. So let's understand one more question. Okay. So before I will just let me check if you have any quote by the time you might have given. So can you please explain interest part? Okay. Mohammed Abdul Rahim. Okay. Very good. So I'm just going to explain the interest part before I move further. Okay. Now here, look at this, it's very simple, let's go back here. Interest on outlay of funds. So this is what, Mohammed, you want to understand. So, what happens was that the bank was supposed to give you money on 31st of December. Okay, because you are supposed to receive your dollars on 31st. But now you have received your money on 30th November, okay, from abroad. So bank is going to convert the dollars and going to give you money 31 days before. Okay, so they have paid you money, at the same price at which they have booked your dollars. They give you a rate of 65.40, which was applicable on 31st December. So they're not changing that rate. They're giving the same money, but a month earlier. Okay, but on the same day, they are going to, whatever dollars which came to the bank from your customers, and they are going to sell those dollars. So there will be an inflow and outflow happening on both accounts. First, they're going to, give you money. They're going to convert your dollars at 65.40, okay, a month earlier than what it was earlier. as per the contract. But now they're going to even, get some kind of inflow also on the 30th November, because after all, they're going to receive dollars and they're going to sell them at 65.22. So that's there in the question. So that means the bank has actually spent 18 paisa per dollar more. Okay, more, and it is only the timing difference. Okay, fine, because the loss and everything we have already covered in the swap loss. Okay, so this is just an inflow and outflow of funds. So there was an extra outflow of fund which happened, which was 18,000. There was a 1 month. This would have happened after a month. This has happened. On 30th November. So bank is going to charge interest for that. So $1 lakh for 31 days. It will be for at $0.18 per this thing, and then 0.18 rupee, sorry, per dollar. So for 31 days at 18%, the rate of interest is given in the question. It comes to 275. I hope it is now clear. So let's move on to the next question. Okay. So I hope you have followed now. Is it clear? So, but what about if you go for late deal? Now we'll go for that. Okay, there are a lot of questions which are going to happen, so don't worry about that. So don't jump the gun. So in this question, the interbank covered rate for forward sale by the bank is not given. It means it is assumed to be 65. No, it is not assumed. So we don't have to even look for that. We don't need the interbank rate at which the bank sold those dollars. First the bank has given. So at what rate they are going to buy. So that rate is not required at all. Okay, so please revisit the question and you'll find that we are not assuming anything. Okay, so let's go to the third question. Yeah, on 15th of January, 2015, you as a banker booked a forward contract for US dollar 2,50,000 for your import customer. So customer is an importer, so they need $2,50,000 when on 15th of January. Now deliverable on 15th of March. Okay, so you approach to the bank on 15th of January. You require dollars 2,50,000. You are an importer, and the dollar needs to be delivered to the customer. Okay, fine. On 15th of March 2015, and the rate which is given by the bank to you is 65.3450. On the due date, the customer requests you to cancel it. Okay, what happened? You have already entered into contract with the bank, and now the customer says that I want to cancel this contract. On this date, quotation for US dollar in the interbank market is as follows. The spot rate is 65.29 oblique 2975 per dollar. And there is some forward rates for April and May also given to you. Okay, which is we are not going to use at all because they won't be required, because on the due date only the cancellation is happening. The spot rate will be applicable here for cancelling. Assuming that the flat charges for cancellation is rupees 100 and exchange margin is 0.10%, then determine the cancellation charges payable by the customer. Okay, so let's understand that. So I'm just going to explain it on my slide, and if required, I'll go to the board and also explain on your request. So on 15th of January 2015, the import customer bought forward contract for how much? $2,50,000. Deliverable on 15th of March, and the rate given by the bank was 65.3450. Okay. Now, what happens on the due date? That is 15th of March. You request to cancel the contract. So the customer said, I don't need this. I want to cancel this contract. Okay. So first, there was a contract to deliver the dollars at 65.3450. So you are an importer. So the bank was, selling you dollars at 65.34. Now, interbank spot rate on 15th of March, which is given to you, $1 is equal to 65.290 and 2975. So this is the due date. On the due date, you approach the bank and say, I want to cancel the contract. So what the bank is going to do, the cancellation of original contract means reverse action of the original contract. So importer must sell $2,50,000 on due date. That is 15th of March. to cancel the original contract at the spot rate of 65.29. So the bid rate will be applicable because the customer is now going to sell the dollars. First he bought the dollars, okay. Now he's going to sell the dollars. So this whole process is going to cancel off his forward contract. So first he entered into forward contract to to buy the dollars. Now he's selling the dollars. Okay. Now we know that these are interbank rates. Okay, which is 65.29. The bid rate will become applicable because he's going to sell the dollars. Okay. So first we need to convert the interbank rate to merchant rate. So which we have already covered in our earlier videos, the whole process. So you can just go through again. So interbank spot buying rate is 65.29 on 15th of March. So the bank is going to, reduce the exchange margin, which is 0.10% of 65.29, which comes to 0.0625, 0.0653. So, in case of a bid, we reduce the margin because here the interbank buying rate is 65.29. Okay. So we are going to reduce the margin. So now, because now you're actually, now as a customer, you are selling. Okay. And the bank is buying from you. Okay. So the bid rate minus the margin, which is 65.227, which will get rounded off to 65.22. Okay. So here the margin, when from bid we reduce the margin, from us we add the margin. So we understood this in our earlier videos. So because the bank is going to give you the the dollars at 65.2250, but it is going to cost them 65.29 in the interbank market. So they are going to make a profit on that, which is 0.0653. So they, you are going to now in the first transaction, what you are happening was you were actually you bought the dollars. So let's look this thing. You sold the dollars, okay, and now you are going to buy the dollars. Okay, the dollars sold to the customer. So customer bought earlier because as an importer. Now customer is selling. Okay, so customer want to sell those dollars. Okay, fine. So let's go back here. So customer is here selling his dollars. Okay, first he has bought, now he's selling. Since now he's selling, so he will get a rate of 65.2250, whereas the interbank rate is 65.29. So the bank is going to get the dollars at 65.29 and going to charge. The bank is going to, the customer is going to give the dollars at 65.2250 to the bank. Okay, the bank is going to sell them in the interbank market at 65.29, making a profit on that. Okay, so because now you are selling to the bank and the bank needs to, sell it in the interbank market. So they are getting a rate of 65.29 when they sell in the interbank market. So you sold at 65.2250 to the bank and bank sells it at 65.290. The margins are getting adjusted for that. So the bank still makes money. Okay. So the first contract was the dollar sold to the customer. Okay. The first was that the customer bought the dollars from the bank. Okay. Because he was an importer. So he bought the dollars at what rate? 65.3450. Now, because you need to cancel the contract, now you have to sell the dollars. So customer has to sell now. So the rate will be 65.2250. So the net amount payable by the customer will be 0.12, because if you see customer has bought at 65.34 and he has sold at 65.22. So there is a loss which is accruing to the customer, which is 12 paisa. So the amount payable by the customer would be 100 rupees the flat charges, which is given the question, and the cancellation charges are 0.12 rupees per dollar multiplied by $250,000. So that means $30,000. Okay. So now please let me just have your comments. Have you followed? Okay, clear. Prashant sir, in the previous question, in order to cancel the contract with the customer, why we have used the interbank rate? It should have been the merchant rate. Yeah. Now it will all depend upon, in the question, if you just go back to the question again, so here you're talking about this question, okay? Fine. Where, X and a quota enters into, and due date, so X receive the amount, bank to take delivery, the bank rates. Now, of course, again, there are no, give. I mean, the the desired information is not there. If you can see, okay, fine. So we have assumed that these are the interbank rates are the same as merchant banks because the information is not there. So we couldn't do that. Okay, fine. So if the information would have been there, we could have applied and converted them into merchant banking rates. Okay, so let's go to now the question number 4. So if you have followed this, so please let me know. So this is an early cancellation. Now we're talking about an early cancellation. Okay. Namrata, please summarize this. Okay. So let me just summarize this. So this is good. Okay. So this is a very important. So what has happened was that this guy has gone. He's an importer. Okay. So he needs $250,000. Okay. And he approaches the bank on 15th of January, and he wants the dollars on 15th of March. So the bank gives him a rate 65.34. So bank has sold the dollars to the customer, or the customer has bought the dollars. One the same thing. Okay. So the customer has first bought the dollars from the bank. Okay. So on the now, because he's going to cancel it. So first he has bought, he's going to cancel it by selling those dollars, isn't it? Fine. So on due date, the customer requests to cancel the contract. So listen me once again that he has bought the dollars from the bank. Now he doesn't require the contract anymore. So he needs to cancel. So once he has bought, he needs to now sell these dollars to the bank. Okay. So by buying and selling, the forward contract will get over. So on this date, the quotation is given to you, which is 65.290 and 65.2975. So these are the rate. So first he bought, now he's selling. The selling rate will be 65.29 because on the due date. So the rates which are given for April, May will have no significance. We can just simply ignore them. Okay. And since these rates are interbank rates, so we have been given additional information with regard to exchange margin. Okay. So we need to do that. So first, what happened was the customer bought the dollars at 65.34. Okay. Now he's going to sell these dollars at 65.29, which is the bid rate. Okay. Fine. So since it is an interbank rate, so we are going to convert them into the merchant rates. Okay. So the exchange margin is 0.10%. So it comes to 65.22. So now look at this. Customer has first bought the dollars at what rate? 65.3450. Now he has to sell the dollars back to the bank so that the transaction gets over. So in this process, he has suffered a loss of 0.12. So because he bought it at he bought it at 65.34. He's selling at 65.22. So there is a loss of 0.12. So if you multiply this with the number of dollars, so it will come into rupees, which is 30,000. So he has to pay another 100 rupees as a flat charge. It's there in the question. So that's it. So have you followed now? I mean, I have summed up. Okay. Namrata, is it okay? So if you have followed, please confirm. Okay. Early cancellation. So we'll do one more question before the break. So if a forward contract is required to be cancelled earlier than the due date of the forward contract, the same shall be cancelled at the opposite rate of the original contract of the date that synchronizes with the date of original contract. So what it means, so we'll understand this through an example. Okay. So let's understand. So you as a banker has entered into a 3 months forward contract with a customer. Okay. So you are a banker. You have entered into a 3 months forward contract with your customer to purchase Australian dollars. Okay. At the rate of rupees 47.25. That means your customer is nothing but an exporter because he's going to get Australian dollars. So the bank has entered to purchase these dollars from the customer who is an exporter. So he's going to get $1 lakh at the rate of 47.25. However, after 2 months, your customer comes to you and requests to cancel the contract. So he has come, not on the due date, but after 2 months. So there is yet 1 more month to go. So this is an early cancellation. So on this date, the quotation for Australian dollar in the market is as follows. The spot rate is given and even the 1 month forward is given. Okay. So this will be very important that we have to use the 1 month forward because he has come early. Okay. Determine the cancellation charges payable by the customer. Okay. So now the customer entered into a 3 month forward contract to sell the dollars. He's an exporter. So he said, okay, I want to sell my dollars. The rate was given to him was 47. So however, after 2 months, he comes. So customer buys the 1 month forward contract to buy the dollars. Now he has to, buy a 1 month forward contract. First he has sold, now he has to buy, but not at the spot rate, at a 1 month forward rate, because still 1 month to go. So this, to cancel the contract, he has to synchronize both the dates. So because there is still, 1 month left, so he is going to buy a 1 month forward contract. Okay. So the net amount payable, now again, here we are using the interbank rates because there's nothing more information given to you. So we are going to net amount payable by the customer would be 0.27, which is the difference. So he bought it at 47.52. He's selling at 47.25, thereby making a loss of 0.27. Okay. So the total cancellation charges payable by the customer would be 1 lakh multiplied by 0.27. Okay. So here the rate applicable would be the ask rate, because now in the second customer buys, so he's going to buy at 47.52. If the quotation is given 1 month forward, so it is 47.52, which is the ask rate, will become applicable here because he's going to now buy. Okay, fine. So that covers our the third question of the day. So I'm just waiting for your response. If you have followed it, got it, sir. Namrata, very good, wonderful. Okay, so have you followed the last question, or do you want I should summarize it again? So before we go for the break, I'm just going to summarize again for all of you. So here, what happens was, that you are basically for contact the customer to purchase $1 lakh to purchase. Your banker has entered into the customer to purchase. Now, the banker is going to purchase dollars from you. Okay, so that means you are an exporter. Okay, fine. So you are going to get 1 lakh Australian dollars, and the bank is going to purchase it from you, or you're going to basically sell these dollars to the bank at 47.25. So, but after 2 months, what happens? The customer realizes that he doesn't require this contract. Okay, so he needs to cancel it. Now there is still 1 month to go. So since you have sold the dollars to the bank, so you need to buy it from now. So you first sold and now you're going to buy. Okay, so let's go back here to understand. So you need to now buy first you sold the dollars to the bank. Now you're going to buy the dollars from the bank. Okay, when you buy the dollars, it is the ask rate which is applicable, which is 47.52. Okay, so first you're going to buy at 47.25, then you're going to sell at 47.54. So what happens would be that the total net amount payable by the customer would be, so you sold at 47.25, you bought it at 47.52. Okay, so which means the net amount payable by the customer will be 0.27, that difference basically. So you bought at a higher price and you sold at a lower price. So there is a loss which is going to accrue to the customer, which is 0.27 rupees per Australian dollars. So if you multiply it with the Australian dollars, so we will have 27,000. Okay, fine. This is $1 lakh. Okay, fine. So that's it. So we are going to now have a break. So let me understand if you have any queries. Okay, Mancha has got it, sir. Why swap loss and interest on outlay funds are not come in early cancellation forward contract? Why 1 month forward contract and customers? Why the spot is not considered? Namarada, why 1 month forward bought by customer? Why the spot rate? Yeah, that's a very good question. Okay, I'll answer that. Sadish, you need to wait for some time. After the break, I'll just go back to your question. So now here what was happened was that since you have approached the bank after 2 months, so bank is going to basically sell you the dollars after 3 months. Okay, so 2 months have already gone by, 1 month is remaining. So that means the customer has to buy 1 month forward, isn't it? So that it's synchronized with your date of selling and buying becomes on the same day. Okay, so you can't do the spot rate here. Okay, fine. The spot rate would be that it is not going to cancel the contract because your contract is still 1 month to go. It's a forward contract. So the date of the forward contract and the cancellation date has to be same. Okay, so that is why the the contracts have been cancelled. And because if you just go and see here, the theory part, so you will understand that early cancellation. If a forward contract is required to be cancelled earlier than the due date of a forward contract, same shall be cancelled at the opposite rate of the original contract of the date that synchronizes with the date of original forward contract. So that's a catch here. Okay. So now, have you followed, Namrata? Please confirm. So we break now. It is 8:25. So we have about 15 minutes of break, and we come back after the break. Okay. Okay. So we are back now. Since we have to cover, some questions and, last topic, which is postponement to accounts. So that's why, we are starting a little earlier than scheduled. Okay, so Namrata, you have got it. Okay, now, there was a question regarding, Satish Kumar, why swap loss and interest on funds do not come to cancellation for? No, it doesn't come to, because when we cancel the contract, what happens is that the original contract, which was, done in a covered contract, they also get, reversed by the reversal action. So there will be no swap loss or interest on outlay of funds because it is happening. Okay, so there is no swap loss as such. Okay, so we'll just go because the contract gets cancelled. So let's talk about now early cancellation. So if a forward contract is required to be cancelled earlier than the due date, the forward contracts, I hope I'm just sharing my slides with you all. Yeah, okay. So the same can be cancelled at the opposite. So this we have already done. Okay. Sorry, we covered all this. So extension on due date. Now the question is extension on due date. Okay. So we'll just go straight to the question. Okay. Now this question is such that we have to require some attention here. So I put something on the red on the spot rate. If you can see, the spot rate are 62.72 and 62.68. Okay. Whereas the 1 month forward rate is actually in order. So here the bid and ask rates have written in jumbled order. So bid has to be always lower and ask has to be always more. So this is just to confuse you. So otherwise you should take 62.68 as bid rate and 62.72 as ask rate. So I put this red marker here. So while solving, you should keep that in mind. Okay. Suppose you are a banker and one of your export customer has booked US dollars 1 lakh in a forward sale contract for 2 months with you at a rate of 62.52. And simultaneously, now you are an export customer. Okay. So you are going to receive $1 lakh. So you are going to sell those dollars for a forward rate of 2 months. So the rate is 65. And simultaneously, a banker you covered yourself in the interbank market. Now here you means the banker. So they covered this transaction in the interbank market. So they took the dollar from you at 62.52 and they sold it at 62.529. So they had made a profit on it, as you can see. However, on the due date, after 2 months, your customer comes to you and requests for cancellation of the contract and request for extension of the contract by 1 month. So you don't want this contract now. Okay. So you want to cancel it and you want to extend this contract by 1 month. Okay. So on this date, so it's happening all on the due date. On this date, the quotation for US dollar in the spot market is given as 62.68 and 62.72. And a 1 month forward rate is also given because, right, okay, which is going to be, you need to actually sell your dollars. So the rate perhaps will be 62.64, which will become applicable to you. So determining the extension charges payable by the customer, assuming the exchange margin is 0.10% on buying as well as selling. So first, on the due date, after 2 months, your customer comes to you and requests for cancellation. Okay. So since you have earlier sold your dollars, now you're going to buy them. Okay. First, the original contract shall be cancelled as follows. So US dollar spot selling rate is given to you, which is 62.72. So you're going to add, now the rate is given at the bottom, 62.68 and 62.72. So this is the buying rate. Okay. The contract shall be as follows. The US dollar spot selling ask rate is given as, so for you it will be the ask rate, the buying rate. For the bank it is a selling rate, 62.72. Okay, fine. So you are going to now, you have sold first, you are going to buy now. Okay, so cancel contract will get cancelled. So the margin is given. Okay, so we need to add the margin. So net amount payable by the customer as per dollar comes to 62.7827. So which will get rounded off to 62.78 and 25. How we have rounded off, you can always refer to my earlier video. Okay. So now the bank buys, US dollar from the customer and the customer sells. Okay, so that's the same thing. Customer is selling and the bank is buying. Now the bank has to sell and customer needs to buy. So from looking from the customer's perspective, customer has actually sold his dollars to the bank at 62.52. Now he's going to sell. He's going to buy. Okay. When he buys, both the contracts get cancelled. Okay. So he's cancelling it. So he's now buying. First he sold. Now he buys. So he buys at 62.78. He sells at 62.52. Okay. So which means loss to the bank to be recovered from the customer will be 0.2675. So he has bought at 62.78. He has sold at 62.52. So that means there is a loss of 0.26. So that means the total amount cancellation charges would be $1 lakh multiplied by 0.2675, which will become 26,750. Okay. So now, the customer wants rebooking. Now, since you are entering into a contract, first you are cancelling it, and then you want a new forward contract to be given to you. So first, the original contract will be cancelled, as you already cancelled that, and the new contract will be the customer wants the forward contract to sell his dollars. So forward US rate is given as 62.640. So now he wants to sell. So if you can see at the bottom, the rate is 62.64. So he's 1 month forward. He's going to, sell his dollars. So margin will be reduced, less margin, 0.6264. So the net amount payable by the customer would be 62.57. Okay, fine. So bank is going to buy them at US this thing selling rate was this, and now this is rounded off to 62.5775. Okay. So now this is the booking rate of the customer. So let's go back and summarize again. So before we proceed to the next question. So here, suppose you are the banker and one of your export customer has booked US dollar for 1 lakh. Okay, so you have an export customer, so your customer wants to sell the US dollars to the bank, and the rate given by the bank is 62.52. Now, the bank is going to sell these dollars in the interbank market. Okay, at the same time, so they're going to enter into a covered transaction. So they took the dollars at 62.52 from you and they sold it, disposed of these dollars through a covered contract at 62.59. Okay, so now they don't have any exposures in dollars. So, but what happened? This was supposed to happen, but you came to the bank and said, I don't want this transaction to happen, so I want to cancel the contract and I want to, kindly extend the contract for 1 month. So first, the original contract needs to be cancelled and a new contract to be booked. So the cancellation rate, you will need to they have the spot rates. Okay. So first you have sold the dollars to the bank. Now you're going to buy the dollars. So the rate will be 62.72 and with the appropriate margin. And now you're going to sell the dollars 1 month forward where the rate will be 62.64. So let's see. So 62.72 is the rate. Okay. So you're going to cancel the contract. Okay. So you have sold the dollars earlier. Now you're going to buy the dollars from the bank. Okay. So the rate is given here. So we calculated it as 62.72. So the bank has first sold at 65. Now the bank is the customer buys it. Okay. So at 62.78. So there will be loss of 0.26. So that loss will be recovered by the banker from you. So this is, and then subsequently the customer wants another forward contract after 1 month. So the 1 month forward rate will apply. So here the customer wants to sell his dollars, which is going to get after 1 month now, not on the due date. Okay. So the rate will be 62.64, which is the bid rate. So you do the margin part and then you found that the rate comes to 60, the forward rate contract will be 62.5775 after rounding off. So that's all. So now extension before the due date. Okay. So we are going to simply do the question to understand. So let me see if you have any questions. Yes, sir. You have followed. Good. So let's now go to back to the question. Exercise number 6. So 2 more questions remain. So I didn't want to, then we have to do nose throw and goes through account in the balance time. So I would like to just bear with me. Okay. So this question is, suppose you as a banker entered into a forward purchase contract for $50,000 on 5th of March with an export customer for 3 months at the rate of 59.60. So you entered as a banker, you entered to purchase how much? $50,000. When? On 5th of March. That was the date when you enter the contract, and the money will be coming after 3 months. The rate was given by the banker was 56. On the same day, you also covered yourself in the market. That means the bank also covered. So they got the dollars at 59.60. They purchased the dollars for the customer and then they sold it off through a covered contract in the interbank market at 60.60, thereby making a profit on that. Okay. However, on 5th of May, okay, the customer came to you and request extension of the contract to 5th July. Okay. So after 2 months, I think you have come back to the bank and say that I need extension. On this date, the quotation for US dollar is given to you. The spot rate is given and the forward rate of 5th June and 5th July. So the red marks are by which we are going to use them. Okay. So assuming the margin is 0.10, okay, so we need to calculate. Okay. Steps 2 for cancellation of 3 months contract. Exporter customer entered into a 3 months forward rate. So he has entered into a 3 month forward sale contract for US dollar 50,000 on 5th March at the rate of 59. So you entered into a forward sale contract with the bank to sell your dollars at $50,000 at 59. On 5th May, okay, after 2 months, the contract will be cancelled by 1 month forward purchase contract because still there is 1 month to go. So it needs to be synchronized with the original contract. So you're going to cancel it by 1 month forward purchase contract. Okay. So the 5th June, the rates are given to you, which is 59.23 and 245. So you're going to look at the ask rate here because now first you has actually sold. Now you're going to buy. So the ask rate will be applicable and these are interbank rates. So you're going to convert these interbank rates to the merchant rates. Okay. By adding exchange margin, which is given in the question as 0.10%. So which comes to net amount will be 59.3017 and you round it off to the nearest multiple. So it will come to 59.3025. Okay. So the forward rate is given to your question as 25, which we already know. Okay. So now the cancellation charges. Customer sells, original contract. He was selling his dollars. Okay. At 59.60. Now he's buying the dollars from you at 59.30. Of course, it is done in a forward rate contract so that it gets synchronized with the original contract. So original contract was to sell a 3 month contract. So now 1 month is remaining. So they're going to enter into a 1 month forward contract to nullify the original contract. So difference will be 0.2975. Okay. So this multiplied by 50,000. Now, what happens is that customer has bought at 59.30 and the customer sells at 59.60. So there is a profit to the customer, 0.29. So this amount will be payable to the customer. So bank generally pays off this amount to the customer if there is a gain. If there is a loss, the bank is going to recover the loss from you. Okay. Now, rate for booking a new contract. Now, here the customer wants that he needs a new contract on 15th of July. Okay, so we'll look at the rate of 15th of July. It's the 5th of July, I think. By mistake, I've written 15th. So let me just check. 5th of July. So this is going to be 5th of July. So on 5th of July, he needs a new contract. Okay, fine. So bank's forward buying rate is now they are going to buy dollars from the customer, or customer is going to enter into a forward selling rate, so which is 59.63. Okay, so the bank enters into a contract to buy these dollars at 59.63. Okay, and the exchange margin is 0.10%, which is going to be reduced, and net amount payable by the bank to the customer would be 59.5704. So if you round them off, it will come to 59.57. So this will be the new contract. So the customer has cancelled the old contract and he has booked a new contract for 5th July. Okay. So let's again hurriedly go and summarize this. So here, what happened was that, the banker entered into a purchase contract. So you are an exporter, you're going to receive $50,000. Okay. When? On 3 months from 5th of March. So the bank says, we are going to take your dollars at 59.60. and on the same day they are going to dispose of these dollars. With of course, we are not going to use in our solving the question. But on 5th of May, after 2 months, you said you went to the bank and say, sorry, I don't want this contract, so kindly extend my contract to 5th of July. So the bank has to first cancel the old contract and rebook a new contract. Okay, fine. So that means in the fourth box, we have put red this thing. Spot rate is given on 5th June. So on 5th June is going to and 5th July. Okay, so these are the rates which are given. Okay, and then we are going to just look at. So this is exporter entered into 3 months forward contract. Okay, so he is going to now, after 2 months, he is going to cancel. So he is going to cancel at 1 month forward paid purchase contract. So that's why we have taken the 5th June and not the 5th May. Now there is no number 5th May. So here he's going to cancel the contract. Now the cancellation will happen only when both the contracts are synchronized. So that means he has bought the 3 month forward rate, and after 2 months, only 1 month is remaining. So he needs to now cancel the contract rate at going for 1 month forward purchase contract with the bank. So that will be at 59.2425. This is the interbank rate. So we'll convert the interbank rate to the merchant rates, and the rate comes to 59.302. So that means now we have both the contracts. Customer has sold the dollars at the original rate of 59.6. He has bought now to cancel the contract at 59.3. So he buys at 59.3, sells at 59.6. So he makes a profit of 0.29. So the bank is going to give this amount to the customer, which is going to be 14,879, which is 0.29 multiplied by 50,000. Okay. Now the bank rebooks the new contract. Okay. For 5th of July. So we are going to focus on the rates of 5th of July, which are given at the bottom of the screen. So the bank is going to now buy the dollars again on 5th of July. So the rate will be 59.63, which is the ask rate, and which gets converted into the merchant rate will be 59.5700. Okay, fine. So this is the summarization. So last question for this, which is very important, a little bit tougher one. So let me see if, yeah, so you got it now. So now we are going to do a question which is going to be the most tricky one. So let's now late extension. That means you have not gone to the bank on the due date, but you went late after the due date was over, and you want going for extending the contract because you don't need. You realize it very late, and or the information from your exporter or importer came very late, so you couldn't go in time, or because of your personal reason you couldn't go. So you went to the bank quite late after the due date was over. In case the late extension, current rate prevailing on such date shall be applied. So since you are going to have an extension and rebooking, so the current rate will apply. However, before this, the delivery provision of automatic cancellation shall be applied. So there is something provisions called automatic cancellation. So they will become applicable. So these automatic cancellations are given by FEDI, which is an association, frames the rules for forward contract. So as per FEDI Rule 6, a forward contract which remains overdue without any instructions from the customer on or before the due date shall stand automatically. So this is FEDI is a foreign exchange, I think, dealer association in India. Okay. So as per the FEDI Rule 6 of the forward contract, which remains overdue without any instructions of the customer on or before due date, shall stand automatically cancelled within 3 working days after the maturity date. So the law says, or the FEDI rule says, that if you have not gone to the bank and on the due date and went quite late, so within due date, the transaction will automatically get cancelled. Okay, after the maturity date. So whatever is the date, after 3 days, all the transaction will automatically cancel by the bank. They will not wait for you. Okay, you go to the bank and tell that that I was not there, so they will do it without even any information to you. Okay, or of course they can even inform you later. So let's take about a question here. Okay, so question is, an importer booked a forward contract with the bank on 10th April for US dollar 2 lakh due on 10th June at the rate of 64.40. So you are an importer So you booked a contract to buy dollars when the date was 10th of April when you approached the bank, and you require the dollars when 10th of June. How many? $2 lakh at the rate of 64.40. The bank covered its position in the market at 64.28. Okay, so the bank is going to, give the dollars to you at 64, but the bank are going to procure at 64.28 from the interbank market. So banks are, of course, going to make a profit on that. So the exchange rate for dollar in the interbank market on 10th June and 13th June are given to you. Okay, so why the two numbers are given? Because 13th is exactly 3 days after the due date, and the FDI rules kick in, because within 3 days the bank need to cancel the contract if the customer doesn't approaches the bank. So there are 10th June and 13th June rates are given. Okay, the spot rate is given, June forward is given, July forward is given, August forward is given, September forward is given. So why such rates? Let's talk about them. Exchange margin of 0.10 and interest outlay of funds at the rate of 12%. So exchange margin which the bank is going to charge is 0.10%, and interest on outlay of funds is going to be 12%. The importer requested on 14th of June, so he comes after the 3 days over, for extension of the contract with the due date on 10th of August. So the importer comes on 14th June, which means after the 3 days are over, and the FDI rule says that the contract needs to be cancelled, automatically cancelled on 13th. So he is late by 1 day. Anyway, rates to be rounded off to 4 decimal places. On 10th June, the bank swaps by selling spot and buying 1 month forward. So what the bank is doing? The bank is, selling spot and buying 1 month forward. Now here I have added a note, just an explanation. This is not part of a question. The bank had covered the transaction by buying. Okay, since you had you were an importer, so you had actually sold your dollars. So bank had bought it. Okay, on that day. Since the customer has not turned up on the bank, turned up to the bank has to close the covered position by selling spot. Okay, so on that date there was a covered contract which was already there, so bank needs to close it. Okay, so bank is basically selling spot to cancel or to take care of the covered contract. So they had a covered contract already to buy. Okay, let's go back and see here. So bank has covered its position at the market at 64.28. So you had, as an importer, you go to the bank and bought dollars, and bank has actually procured those dollars at 64.28 from the interbank market. Okay, so they bought it for you from the interbank market. So now they are going to sell them so that this position gets covered. Okay, fine. So this is what they're saying. So by selling spot. So they have first bought, now they have to sell so that the covered contract gets over. Now, at the same time, they actually went and purchased 1 month forward. Of course, since you had not gone to the bank, so bank thought that you will come and you will need go for an extension. So in anticipation, they have entered into a contract in the forward market to buy. Okay, so these rates are given to you. So the question is, calculate the cancellation rate, amount payable on $2 lakh, swap loss, interest on outlay of funds, if any, new contracted, total cost. So now these are the numbers which are very, which I have shown you. Now we just go through this thing. So the quotation of 10th June and 13th June are given to you. So the spot rate is given, which is 63.80 and 82. So I've added this thing note here. On 10th June, the banks sell that spot rate to cancel the covered contract. So this is an automatically cancellation which is going to happen on 10th. The bank sells at the spot rate to cancel the contract. Okay, fine. So they have and they sold it at a spot rate. Okay, so then look at the June rate, which is the second column. They are buying 1 month forward. So they are entering 2 contracts, to take care of your. One was to cover the cancel contract or cover contract. Another was to buy 1 month forward. So they are entering into these 2 contracts in anticipation that you may come in, may seek for an extension for a month or so. But anyway, now cancellation rate. Now this is basically you canceled your contract. This was the cancellation contract. Okay, fine, because as per FDI rules, the bank is going to on 13th they are going to cancel the this thing. So this was basically to cancel the covered contract. This was to the original contract. So okay, with you and with which the customer has entered with the bank. Okay, so this was the covered contract which bank has gone for themselves to cover the transaction. Okay, so this was the cancellation rate. The cancellation rate is given to you 63.680. Okay, then you bought this, you rebooked your contract, and you wanted a contract to be extended till August. So this is the importer requested for extension of the contract. So this rate will become for that. Okay. So let's now solve it one by one. Original contract done by the bank on 10th April. So our importer booked forward contract with his bank on 10th April for US $2 lakh, which are due on 10th June at 64.40. And the bank covered its position in the market at 64.28. Okay, fine. So original contract, 2 months forward contract the customers to sell the dollars. Okay, so since the bank is going to sell these dollars to you, the customer booked a forward. Fine. So let's go back and check what this customer is. The importer. Okay, so the bank is going to sell the dollars to you. So the original contract to sell the dollars. Okay, since you are an importer, the bank is going to sell the dollars to you, and the rate which was given to you was 64.40, and the date was 10th of June. Okay, this all happened on 10th May. So there was a 2-month forward contract to sell the dollars to you because you are an importer. So bank is going to sell you the dollars at 64.40 when on 10th June. So that means the bank is going to enter into a 2 months forward contract with the customer to sell the dollars. Now, at the same time, they covered themselves by a forward contract to buy dollars in the interbank market. Okay, so they bought it at 64.28 when they did it everything on 10th, but they entered into a contract to buy dollars for a forward contract for the period for 2 months. So they bought the dollars at 64.28. So these were the two contracts which the bank entered at the time when you approached the bank for taking a forward cover to buy your dollars from the bank, and the bank sells to you. Okay. Now on 10th June, what did bank did? They need to now cancel the covered contract. Okay. So they sell the dollars at the spot rate on 10th June. Okay. To reverse the original covered contract. Okay. So they are selling. So the bid rate is applicable. So 63.80. Okay. And they at the same time they entered into a 1-month forward contract to buy dollars. Okay. So this was in anticipation. They bought dollars in the 1-month forward rate, which was 63.95. So once they bought it, so they bought it at 63.95. They sold it at 63.80. So they made a loss, and this is called the swap loss. Okay. So they are going to recover this loss from the customer because they bought it at 63.95. The bank buys at 63.95 from and sells it at 63.80. So there's a difference of okay. Fine. So there's a swap loss on $2 lakh will be 30,000. Now interest on outlay of funds. This is very important. Let's talk about that. The rate of interest is 12%. So sell dollars at the spot rates. Now, because the customer did not turn up to take the delivery on 10th of June, they are going to sell the dollars. Okay. At what rate? 63, which is a spot rate on 10th of June. Okay. So they waited for you, but you were not there. So they sold the dollars at the spot rate at 63.80, which they did it on 10th of June. So on 10th of June, since you are not approached, they sold the dollars. So original forward contract to buy the dollars. Okay. So this was the original forward cover to buy the dollars. So that means they were supposed to buy. They were supposed to sell the dollars to you at 64.28. Okay. So that means there is an outlay of funds. Okay, they sold the dollars at 63.80, but they covered this thing to buy the dollars at 64.28. So they have suffered a loss of, or not loss, but outflow of in terms of 0.48 per dollar. So if you read this, outlay of fund, interest will be levied by the bank to the customer for 3 days. Since all these two transactions happened on 10th and you are not in picture, you came to the bank on 13th. Okay. So for 3 days, the banker has done an inflow and outflow in terms of the money. So they're going to charge you interest. The above transaction cash inflow and outflow occurred on 10th June, but the customer settled them on 13th June. So he has to pay interest on net outflow. And net outflow is how much? 0.48 because they bought the dollars at 64.28 and they sold the dollars at to you. I mean, they sold at 63.80. Okay, they sold the dollars to you on at the spot rate. Okay, so bank bought the dollars for the customer but did not come to take the delivery. So the bank had spent their funds. So bank disposed of these dollars on the interbank market and suffered a net outflow of 0.48 paisa per dollar. So importer comes after 3 days after the date of the the date when he is supposed to come. So for settlement, so 3 days interest will be charged for 12%. Fine. So this is interest on outlay. Now it has been calculated here, which is on $2 lakh multiplied by it will be total amount comes to 96,000. So at 12% for 3 days, it comes to 96 rupees. Now cancellation of the old contract. So now we now the old contract needs to be cancelled. Okay, and new contract needs to be booked. So forward cover to buy the dollars by the customer. Original contract was, so the customer has bought the dollars. Okay, because he was an importer, he needs dollars, so he enters into the bank to buy dollars originally. Okay, old contract, but now he has to sell the dollars. When? On 13th June, the spot rate. Okay, so on 13th June, it will be selling dollars. So with the rate is 63.68. So he sold the dollars at 63.68. So first he's going to buy the dollars. Now he's going to sell dollars by the customer so that the old contract gets cancelled out. And we will use the 13th June spot rate, which is the selling rate will be the bid rate, which is 63.68. And this is the interbank rate. So we are going to, less the margin. So that it will be rounded off to 63.6175. So loss to be borne by the customer would be how much? 0.7825, which is basically the customer, they bought the dollar, customer bought the dollar at 64.4 and he, sell dollars by the customer at 63.61. Okay. So sell dollars by the customer at this. So he acquired the dollars. Okay. Then he disposed of them off at a lower rate. So how much? 0.78. So he bought it at 64.40. He sold it at 63.61. So which means he has suffered a loss of 0.7825. So if you multiply by 2 lakh into 0.78, it comes to 1,56,000. So now the last part, which says that, I'll summarize all this again, so don't worry. The importer requested on 14th of June for extension of the contract with due date on 10th of August. So he wants a new forward contract. So he bought a new forward, he want to purchase now the dollar. He's an importer. So he would like to purchase the dollars for now the contract he wants to bank to extend till 10th of August. So the rate of will be applicable will be first the USD will be 64.18/2500. So the ask rate is, since he is buying, so going to the ask rate. From bid we reduce, ask we add. So we get a rate of 64.3143, which is rounded off to 64.3150. Okay, so this is going to be the new rate. Okay, so importer requested on 14th June for extension of the contract with due date as 10th of August. So we're going to take the rate of August rates. Okay. Now, if you look at the total overall scenario, cancellation charges would be 1,56,000. Swap loss will be 30,000. Interest on outlay of funds will be 96,000 rupees. And the total cost will be 1,86,596. Okay. So that covers this thing. So I'm going to again, take you back. And I hope you're all there. So I'm not still getting your any kind of a reply. Anyway, I'll still, in the absence of any request, I'm just going to cover them again. So here, let's start again and just summarize. So what happens? You are an importer. On 10th of April, you went to the bank and you have to make a payment of $2 lakh. When? On 10th of June. So the bank says, okay, we will, book a forward contract for you and give you the dollars at 64.40. At the same time, the bank has covered its position in the market. So they have actually, sold the dollars at 64.4. So they are going to buy the dollars. So they bought it at 64.28 and sold the dollars to you at 64.40. So they made a profit on it anyway. So the exchange rate for dollars in the interbank market on 10th and 13th June are given to you. Now, since you will find that the customer has not approached the bank on 10th of June, he approached only on 14th. So as per the FedI rules, this has to be automatic cancellation has to take place on 13th of June, and the bank will do it without recourse to the customer. So the exchange margin is given 0.10 and interest on outlay fund is 12%. So the importer requested on 14th of June for extension of the contract with a due date as 10th of August. So he says, sorry, I am coming late, and now I want the original contract to be extended till 14 June. Okay, and on 14 June he came to the bank and he says, I want the contract now the due date to be 10th of August. So bank say, okay, we agree with you, but the original contract needs to be cancelled first, and whatever charges are there, you have to pay that, and we'll extend your contract. So the rates are rounded off. Now, what does the bank does? Because on 10th of June, the bank waited for the customer, okay, but the customer didn't turn up. So they immediately went into action. They entered into a swap transaction by selling spot. Since they have already, taken a covered contract that was there in the system, so they have to sell spot. They can't wait till 13, okay, or 14 when the customer comes. So they have to immediately, come into action. And the covered contract, which was, getting due on 10th June, they have bought the dollars for the customer. They have to sell now, okay. And since they have sold now, so they bought also, okay, on their own account, because they thought that you will be coming to the bank and seeking for extension, or maybe that you may not come, so they bought it for on their own account. So the bank had covered the transaction by buying. Since the customer has not turned up, so they have to close the covered position by selling spot. Okay. So now what we are required to do, we are required to calculate the cancellation rate, amount payable on $2 lakh, swap loss, interest on outlay of funds, new contract rate, and the total cost. So these rates, I have just summarized them again. So rates are given for 10th June, 13th June. So on the 10th June is basically the bank sells at spot rate to cancel the covered contract. So this was basically the first thing which the bank has to do is to cancel the original contract, where the customer has bought, and therefore so they need to now cancel. They have to sell. So they have bought it, now they have to sell it. Okay, so to cancel the old contract, so they have to do it even before they have to wait. They will not wait for the customer. So because the contract is there, so they have to get this contract nullified. So then they buy 1 month forward. So this they did of their own account. Okay, and assuming that some customer will come, or you may come and book for a 1 month forward contract. So they have already done this. So they have buying. So they buy at 9500, which is the ask rate, and they sell at 63.80. Now on 13 June, you came to the bank and you said, I want to cancel the contract. So the cancellation rate is given as 63.68, okay, which is the buying rate, which is the selling rate. So originally you have bought, now you have to sell to cancel the contract. Okay. Now then you have asked the bank to, requested bank to extend the contract for August. So the bank is going to, purchase dollars to you on the forward market at 64.2500. Okay. So now these are the two original contracts which the bank has done. First, they have the forward contract to the customer to sell dollars. So they have sold dollars to you. You're an importer, you need dollars. Okay. So they said, okay, the rate will be 64.40. It's a forward contract maturing on 10th June. So they covered themselves in the forward market by, buying these dollars from the forward market at 64.28, thereby making a profit of 0.21. That is the bank profit. Anyway, now on 10th June, they entered into two swap contracts. One was to sell the dollars at the spot rate to reverse the original covered contract, and they sold them at 63.80. But at the same time, they entered into contract by buying 1 month forward contract. Okay, so in a process, there was a loss of 0.15 paisa per dollar. Okay, so they did it for 1 month forward contract, so which is going to mature on 30th of June. So the swap loss is 15 paisa, which if we convert them into, in money rupees term, it will be 30,000. Okay. So then there was an interest on outlay of funds because you approached to the bank only on 13, on 14. Okay. So bank has already entered into transactions on 10. So there were inflow and outflow to the bank. So extra outflow was 0.48. So they're going to charge you 3 days interest on that. So they charge you 3 days interest, which was 96. And then the old contract was cancelled. The original contract was booked at 64.40. New contract was, for the customer. Sorry, now this is a cancellation. So this is your first bought, and now you're going to sell. So on 13 June, at the spot rate, it was sold. So the rate was 61.6175. First, you bought the dollars from the bank, then you sold the dollars to the bank, and the loss was 0.78, which turns out to be 1,56,000 on $2 lakh. So now the customer says, I want to extend the contract. And I want the due date to be 10th of August. So they entered into a new forward contract. So the bank is going to purchase, the customer is going to purchase the dollars. Okay. So the contract will be forward contract to going to be. Okay, so that will be 64.25. Margins we are going to add, and the new contract will be 64.31. So these are all the charges which the customer has to pay. Okay, so that covers everything. So now we will be moving to okay. Yes, sir. Okay, so this all is there. Wonderful. So now let's move on to the last topic of the day, which is basically nose throw and both throw account. So let's cover that. So it's good that we have time. So this is basically, we are covering the last topic now for the day, which is called nose throw, both throw, and low row accounts. Okay, I hope you are able to see me, see the screen. Yeah, the screen is on. So in interbank transactions, foreign exchange is transferred from one account to another account and from one center to another center. Therefore, the banks maintain three types of current accounts in order to facilitate quick transfer of funds in different currencies. So the bank has to maintain certain accounts so that it helps them to enter into the foreign currency transaction. So they maintain three types of accounts. So first is called, therefore the banks maintain three types of account, current accounts. These are the current account in order to facilitate quick transfer of funds in different currencies, no-through account, goes-through account, and low-row account. So what is a no-through account? Bank's foreign currency account maintained by bank in a foreign countries and in home currency of that country is known as no-through account. So bank foreign currency account maintained by bank in a foreign country and in the home currency of that country is known as no-through account. So let me explain through a diagram here. Okay. So for example, let's say State Bank of India wants to make and receive payment in US dollars in US. For this transaction, SBI India will tie up with, say, Citibank in US. So they approach Citibank. Okay. Citibank US will act as a representative or correspondent bank. SBI India will have an account in Citibank US. So SBI is going to open an account with Citibank in US. Its USD receipt and payment will happen from this account. This account of SBI in Citibank US is SBI no-through account and Citibank's goes-through account. So no-through and goes-through account are actually same accounts, but SBI will call it as a no-through account and Citibank will call it as a goes-through account. So we'll understand that a little bit more. So SBI has an account at Citibank USA, and it is called the no-through account of SBI. So SBI opened a current account with Citibank in USD. This is called no-through account. So a no-through account is a reference used by Bank X to refer as our account held by bank Y. So that means a bank X is opening their account in another bank called bank Y, and they say this is our bank account, okay, our account held by bank Y. Nostro is a shorthand way of talking about our money that is deposit at your bank. So it is our money. So that means I have a bank account and it is in some other bank. So it is my money lying in your bank. So Nostro account is a record of bank that has money on deposit at another bank. So these accounts are often used to simplify the settlements of trade and foreign exchange transactions. The purpose is basically, if you say Nostro account, that means it is used for facilitating the foreign exchange transactions between the banks. Now, the Vostro account, which is same as Nostro, but it is referred from the point of view of the foreign bank. Vostro is the term used by Bank Y, where Bank X money is on deposit. So Vostro is reference to yours and refers to your money that is on deposit at our bank. Okay, now Citibank will say that I have got a Vostro account of SBI because SBI has a Nostro account and Citibank will call it a Vostro account. In example which I just gave. Nostro and Vostro are two different terms used to describe the same bank account. The terms are used when one bank has another bank's money on deposit, typically in relation to international trading or other financial transactions. So Nostro comes from the Latin word ours, as in our money that is on deposit at your bank. Nostro comes from the Latin word for yours, as in your money that is in deposit at our bank. Okay. So Loro account is basically when a bank has not opened a Nostro account. The bank is so small, for example, they can't open a Nostro account, so they'll use somebody's Nostro account. Okay, so then that we say it's a Loro account of that bank which is not able to open a Nostro account by itself. So when domestic bank use the account of third-party banks which hold a Nostro account to settle the foreign transactions. These types of transactions include under Loro account. So let's give an example. HDFC Bank has an account with Citibank. Okay. So HDFC Bank has a Nostro account, but IDBI Bank doesn't have any Nostro account with Citibank. IDBI Bank has to pay the bill of imported machinery from USA on behalf of its customers. So IDBI Bank approaches HDFC Bank and asks to settle the invoice on its own behalf. Okay. HDFC Bank worked as an intermediary between Citibank and IDBI. Okay. So that is basically an example of Loro account. So IDBI is using, when they say that we have a Loro account, that means they don't have their own Nostro, they're using somebody else's account, Nostro account. So they'll call it is our Loro account. So that means that IDBI Bank doesn't have an account. So it's our Loro account. That means the bank is a Nostro account of some other bank, which they're using. So important concepts, they're very important. Exchange position and cash position. So these are two very important concepts under Vostro and Nostro account. Exchange position. Now, a bank can issue a forward contract for buying dollars or any other currency. Similarly, they can enter into a forward contract to sell dollars or any other currency. So that is the exchange position because it's a forward contract. Okay, fine. So all this transaction which the bank is doing, whether in form of buying a TT, selling a TT, or any transaction which is in the nature of traveler checks, the bank's issues, this is going to affect the exchange position of the bank. So at time the bank may have overbought exchange positions because bank may have actually bought more dollars and they have sold less. Okay, so I told you only the bank covers those transactions. Okay, till the time they don't cover, they will have an adverse exchange position. And there is a cash position. That means how much money you have in your Nostro account. Okay, so that is the cash position. So let's understand then exchange position. Balance of aggregate purchases and sales made in foreign currency. So all the transactions which you have entered, or purchase and sales in foreign currency, they will be all telling you what is your exchange position. Are you overbought or oversold in terms of foreign currency, whether it be dollars or pounds or whatever. Okay, so bank needs to monitor that on a daily basis so that they have a position which they can always bear with. Okay, so if they have kind of a foreign exchange position which is not covered, so they are taking a risk. Okay, so they just assess every time how much position, how many forward contracts they have entered, how many they have sold. So what is the net position? Okay, so they are going to be talking about. So they take some actions and monitor their banks, their positions every day. It includes both spot and forward transactions. which means whether you're sending money on a TT basis to some other country in terms of dollars, or you are entering into forward transactions in terms of forward buy contracts or sell contracts, all transactions, whether it involves immediately outlay of money in terms of dollars or any currency, or it may even involve at a later date, because the forward transactions are going to mature only after some time, and actual real flow of money is going to happen much later. So all transactions they are going to record at one place. Okay, purchase of dollar and sale of dollars. Okay, so transaction for which the bank has agreed at a firm rate, firm commitment, like draft issued. Okay, so they have issued a draft. So they have already made a draft. Suppose some person approaches and say, I want a draft for $10,000. So they have made a draft. Okay, so they have agreed to take care of that $10,000 to be paid to someone when it happens. So exchange position is worked out every day. Okay, every day, so as to ascertain the position of the bank on that particular currency, and whenever remedial measures are needed, they may be taken. So the bank wants to maintain that they don't have overbought or oversold position in foreign currency. So they don't want to take high risk. So they need to see that all transactions are covered on an appropriate time, and they don't have undue exposure in foreign currency. So the exchange position is going to help them out. Okay. Now, examples of sources for banks for purchase of foreign currency are, so let's look at some example, like purchase of, DD. So somebody comes and purchases a DD from the bank, which, he has to remit it to a foreign customer, supplier. So, it can be a DD. And so this is basically, exposure to the bank. Traveler's checks. So when you are traveling abroad, you approach a bank and take traveler's checks. Okay. Now, when you go abroad and sell, then only the actual flow of transaction will happen. But the bank has already made a commitment by issuing a traveler's check to you that you can spend. Suppose I take a traveler's check of $10,000. So now I can spend those $10,000 when I visit US, but I may do it, in a 2 months time or 3 months time, as long as I'm US. So only the outflow for the bank will happen only when I spend that. Okay. But bank has given a commitment to me. Purchase of bills, export bills. Now, the bank can purchase export bills. Now, suppose, there is a bill amounting to, say, $10,000. So bank has purchased, okay, which is falling due, say, after 90 days. So bank is going to get dollars after 90 days, okay. So the bank has, entered into a transaction by purchasing a bill. So there is a commitment made by the bank that they are going to get those $10,000 after 90 days. So, there's some customer who has, sold his bill to the bank. So bank is purchased. Okay. And it is, say, $10,000. It is due, say, after 90 days. So bank is going to actually get the dollars after 90 days. So today the bank has done a commitment. Forward purchase contracts with export customers. So if you have entered into a forward contract to purchase dollars from a customer, okay, entered in a position on the date of purchase. So you have, entered there. So this is the inflow of foreign currency. So this is, all this will lead to money coming into your account, nostro account, okay, later on, but not today. Okay. So since you have purchased the export bill, which is going to due on be after 90 days, so you're going to get the money only after 90 days, then only it is going to hit your nostro account. Till the time it will remain into your, position, which I called it as a exchange position. Okay, fine. So then there can be examples of outflow of funds also. For example, issue of DD. You are issuing a DD, demand draft, or telegraphic transfer you're making. Traveler's checks you're, issuing. Okay, fine. Payment of bills. Now you are going to make payments of bills for importers. Okay, so that means it is also involving an outflow of funds. Okay, then forward sale contract with importer. So you are entering into a contract whereby you are telling importer that we'll, sell you dollars, say after 3 months. So it is going to, increase your exchange position that there is an outflow of foreign currency. Okay. So cash position, it's an outstanding balance, debit or credit in bank's nostro account. So this is like a real bank balance. Okay. So it is an outstanding balance. How much money you have, in dollars, say in like SBI having a nostro account with Citibank. So he says, I have $10,000 lying in that account. Okay. So it's a nostro account. Cash position is affected only when the actual delivery has taken place. Okay. So it's a cash position. Whenever the transaction materialize, then only it is going to hit your bank account. All transaction affecting cash position will affect the exchange position and not vice versa. So all transactions which are affecting cash position is going to affect the exchange position, but not vice versa. So this is very important. So all transaction affecting the cash position will affect the exchange position, but not vice versa. Because if you are going to if you are selling a forward contract to someone, it is not going to affect your cash position. It is not going to hit your nose through account immediately. Okay, only on the maturity is going to affect your cash position. But all transactions, whether they are cash or whether they are future commitments, they are going to affect your exchange position. Okay, fine. So let's understand some foreign exchange instruments. Is very important to understand telegraphic transfers, bank drafts, and checks, forward contracts. So first is telegraphic transfer. The money is deposited with the bank in India, and here the money is deposited in the bank in India, and the Indian banker sends a cable, telegram, or a fax to the foreign branch to make certain payments to the specified party on that very date. So exchange position immediate, cash position immediate. So on a case of a telegraphic transfer, suppose a customer goes to the bank and says that I need immediate telegraphic transfer to be made for $10,000 to so and so person in so and so country. So in this case, your exchange position and cash position going to get affected immediately because the money is flown from your Nostro account and you have made a commitment also. So that means exchange position and cash position is going to be absolutely at the same time, you have impact on that. Now, if you have issued bank drafts or checks, now you know that when you issue a bank draft or a check takes or bank draft takes some time to, when the person who gets the bank draft or checks, he deposit in his account, and then only, after some time it is going to hit your account. So bank overdraft or your account means bank's account. So bank overdraft or demand draft is handed over to the buyer who sends it to the beneficiary. The beneficiary obtains the payment on presentation to the bank on which the draft is drawn. So exchange position immediate, cash position not immediate, because suppose a person takes gets a check issued or a bank draft issued, so he's going to send that bank or a draft or a check to the foreign country, and that person is going to make a present of those checks in bank draft. Is going to take some time, maybe a week or maybe 10 days or maybe a month. So exchange position is immediately affected because you have already made a commitment by issuing a bank draft. But your Nostro account may not affect immediately, so your cash position is not going to be affected immediately. Forward contracts. These are essentially hedging instruments with no upfront payment. So since you are entering into forward contracts, which doesn't involve an upfront payment, exchange position immediate, cash position not immediately, only on delivery. That means only on the date of maturity of those forward contracts, your Nostro account is going to get affected. But till the time you know that I have made some commitments to someone, so you're going to put it in an exchange account, but your cash position is not going to get affected. So similarly, foreign telegraphic transfer, forward telegraphic transfer. So that means you're not making now, and somebody says make a telegraphic transfer after a month. So here also your exchange position is immediate, cash position is only when on the time of delivery. Okay. DD purchase, similarly, exchange position immediate, cash position not immediate. Bill of exchange, again it will take time. So exchange position will be immediate and cash position not immediate. Okay. So let's do some questions to understand this concept. So let me just see if I've got some queries from you. Okay, pardon me, sir, but could you please tell us these accounts made for interbank transaction or transaction of the same kind? Who is asking? Miss Tanisha Rativia. Okay. Pardon me, sir, but could you please tell if these accounts are made on interbank transaction or transaction? Now, these are basically, these are firm commitments. Okay. And of course, they are going to be basically these are customer to bank transactions. Okay. So when a draft is issued to the customer, so it will be at a merchant rate. Okay. Fine. So they are not, these are all the merchant rates kind of exposures. But the exposure is happening basically on the interbank rate. The merchant rate is basically the difference is just the profit which the bank is going to earn. Okay. Fine. So, sir, when to take bid and ask rate from the customer's point of view. So this I have Kumari Jyoti, I have explained that in my first video. So please, you have to go and listen to that video. But still, for the benefit of your doubt and for your interest, I'm just explaining the bid rate and ask rate. Now you can look it from the bank's perspective, and you can look it from the customer's perspective. Now, if you are looking from the customer's perspective, like suppose Kumari Jyoti needs dollars, okay? Suppose you want to buy dollar. So the ask rate will become relevant for you, okay? But suppose you have got dollars. Suppose I give you $10,000 for some services which you have provided to me. I give you $10,000. Now you go to the bank and you want to convert that in Indian rupees, then it is a bid rate at which it will be converted. The money will be converted to Indian rupees and will be credited to your account. Okay. So bid rate is a rate at the rate which you sell the dollars as a customer, and ask is when you buy the dollars from the bank. Okay. So this is the ask rate is for buying. So one way would be the bid rate is applicable for exports. When you get your money in foreign currency, you go to the bank and say, this is my dollars, please convert them into Indian rupees. So it will be converted at the bid rate. Okay. And ask rate is generally meant for the importers. That is a way of remembering it. So, when you have to make a payment on your imports, so you have to look at the ask rate. And for your information, bid is always lower, ask is always higher. When you buy a foreign currency, you buy at a higher rate. And when you sell your currency on the same day, you sell it at a lower rate. So banks are very happy people. So they want to make money. Okay. So they give you a spread. So at lower rate, they're going to buy from you. At a higher rate, they're going to sell to you. Okay. Fine. Okay. Tanisha, I think you got it. So let me just do some questions. So suppose you are a dealer of ABC Bank. On 20th of October 2023, you found that the balance in your Nostro account with XYZ Bank in London is 65,000 pounds. So you have a Nostro account in London, and we know that England, the currency is pounds. So you have a Nostro account. Okay. So ABC is a bank who has a Nostro account with XYZ Bank in London, and it shows a balance of 65,000, and you have an overbought situation of 35,000. So that means exchange position is overbought, and your account shows a 65,000 rupees pounds. During the following transactions takes place. Okay, so let me just put it here again. So the same question. Suppose you are a bank. Okay, this we have done. During the day, following transaction takes place. DD purchased 12,500 pounds. This is a transaction which is happening on a day. Okay. So how many transactions happen? 1, 2, 3, 4, 5, 6 transactions. So somebody purchased a DD. So you purchased a DD, sorry, for 12,500 pounds. Okay. Then that means the pounds are going to come into your account. Purchase a bill on London, 40,000. You purchase a bill on London, okay, 40,000. You sold a forward TT, 30,000. You actually purchased on a forward purchase contract got cancelled, 15,000. You remitted by TT, 37,500 pounds. Draft on London cancelled, 15,000. What should, if you were required to maintain a credit balance of 7,500 pound in Nostro account and keep an overbought position of 7,500 pounds. So you want your exchange position to be overbought, but you should have some balance of 7,500 in Nostro account. So let's talk about. So you started like this. Your transaction is given on the right hand side, and exchange position one by one, you'll see the drop happening. So opening position is 35,000 overbought. So if you just go here and see that you have a position of overbought of 35,000, the second box it is written, just focus that you had an overbought. So that means, first we are writing purchase of pounds, then sale of pounds. So you have purchased, so you have, more pounds with you. You have purchased pounds, and you have an overbought situation through some transaction which happened in past. This is the opening balance. Okay. So on 20th then 2023, you had an overbought position of this thing. Then you purchased a DD. Okay. So you purchased a DD, that means you purchased pounds. Okay. So 12,500. Somebody, came and you purchased a DD from him, and it was 12,500 pounds. So you purchase the TD, so it will come on a purchase side. Then you purchase a bill on London. Okay, so that will also hit your exchange position. It will come on a purchase of pounds. Okay, then you sold a forward TD. So you are selling your pounds now. Somebody came and he says, I want a TD, okay, in pounds. So you have a balance of 35,000 in the beginning. Then you purchased another, pounds DD. So this DD you have purchased now. The money will come basically only when the DD gets, presented. Similarly, you purchase a bill, the money will come into your account only when it gets presented. So it will hit your exchange position, but not the account. Sold a forward TT. So the moment you sold a forward TT, it's going to hit your exchange position, but may not hit your nostro account. Only the date when the forward date becomes mature, it may hit your nostro account. So forward purchase contract cancelled. So now it will have a exactly opposite effect. Had you sold a purchase contract, it would have been common a purchase, but now it has been cancelled. So that means your exposure has gone down by 15,000 pounds. Now you made a TT remittance. So that means you made a telegraphic transfer of 37,500. You're actually selling pounds from your account to someone. Somebody came to you and he says that I want immediately to be, make a TT, okay, to make a payment for my imports. So the bank says, okay, and they issue a TT, okay, in favor of you for 37,500. Now TT remittance has an immediate impact both on your exchange position as well as no through account, okay. Draft on London Bank cancelled. So you had issued a draft. Now it got cancelled. Okay. So it will have immediately opposite impact. So it will come here. Then, that means if you look at the purchase side and the sale side, so you have a closing balance overbought. So you have bought more and sold less. Okay. Fine. So you had earlier issued a draft. I mean, coming back to the draft, you have sold a draft to someone, so it would have gone to sale side. Now your cancelled, it's coming back to the opposite side. Okay. So overall, closing overbought position is still 20,000. But as per the question, keep as overbought position of 7,500. So the bank needs that there should be a 7,500 overbought position. But you're today sitting at an overbought position of 20,000. So we'll just come back to this exchange position till we cover the nostro account first, and then we do all those actions, which remedial actions that the bank has to do. So on 20th of October, you found that the balance in nostro account is 65,000. So this is your balance. This money is lying to your credit in a foreign bank. Okay. So you have 65,000 pounds with you as a banker. Now, if you look at all the transactions, there is only one transaction which is going to affect the cash position immediately. The rest of the transactions are either forward in nature, only get matured when they are going to hit your account so far. So that means you just close your position. You see that you have a closing balance of, so you had an opening balance of 65,000. You gave a TT. Okay. So your balance came down to 27,500, but you are required to maintain a credit balance of 7,000. So you have a higher credit balance. So that means you have to take one action. So you are going to sell spot pounds. So you sell pounds. So the moment you sell the pounds in the spot market, so your bank account will get reduced to 7,500. So you have to do a transaction because the bank says that you have to maintain a credit balance of 7,500. So you have to sell pounds. So you have to sell pound spot. If you do it in a spot market, it's going to hit your nostro account as well as your exchange account. Okay. So you have this balance. Now we come to the exchange position. So you have added the spot sale. Okay, because you have sold pounds in the spot market. So your position of total exchange position will become same, but you have to keep a overbought position. So that means you will enter into a forward purchase contract of pounds in the interbank market. So this transaction you are going to do on your own behalf, because as per the bank policy, you have to maintain a forward purchase. You have to keep an overbought position. Okay. So the moment you do this, your answer question has been solved. To maintain a cash balance in nostro account at 7,500, you have to sell 20,000 in spot, which will bring the overall position to nil. So since the bank requires overbought position of 7,500, it has to buy the same in the forward market. So we have done that. Okay. So we come to the exercise number 2. If you followed, so please let me know. I'm just going to check this thing. Okay. So there is no response. So I believe that you're following. So now the time is also ticking away. So we do 2 more questions before we wind up. So you as a dealer in foreign exchange have the following positions in Swiss francs on 31st of October 2023. Okay, so these are the transactions which are there. Okay, and the position as on 31st October 2023 is given in front of you. So what steps would you take if you are required to maintain a credit balance of Swiss francs 30,000 in nostro account and keep overbought position in Swiss francs 10,000? So this I put again. So this is the same question. So these are the transactions which have happened. Balance in nostro account is 1 lakh. Opening position overbought is given to you. Okay, fine. And then purchase a bill on Zurich. So we'll just do that while we solve here. So first, let's make a exchange position. So we have, the account is in Swiss francs. So this is your exchange position. So opening balance overbought. So this is given the question that you have a opening this thing. So which is there in the part of your data. So you purchase a bill on Zurich. So that means you have purchased a bill from someone. Okay. So you are going to, get these Swiss francs after some time. So you have purchased a customer's bill in Zurich, okay, for 80,000 Swiss francs. Now you have sold a forward TT. So you have sold someone a TT. So a customer comes to you and he says that I need to make a telegraphic transfer to Swiss francs, but not now, but after a month. So you take a commitment from the bank. So bank says, okay, we have sold a TT in a forward market. Okay. So they're going to sell a forward TT. So that means there is a sale of a Swiss franc after forward rate date has happened. Purchased forward contract cancelled. So the forward purchase contract has been cancelled now. So when you actually issue a purchase contract, so that means Swiss franc would have purchased. Now you have cancelled, will have an opposite impact. So it will be a sale of SF. Then TT remittance. Now here you have made a TT remittance. So you have made a transfer, telegraphic transfer worth 75,000 Swiss francs. Okay. So then we have a draft on Zurich cancelled. So you have actually issued you have sold, Swiss francs earlier via draft, but now that the person comes to you and he cancels the draft. So it will come on the purchase side. So just have an opposite impact. So when you just total both the sides, purchase and sales, you'll find that closing balance is oversold 5,000. But the bank says that you have to keep a over position as 10,000 francs. Okay. But we will revisit exchange account after we see the nostro account. So let's see the nostro account. So nostro account balance is 1 lakh. This is given the question. Then TT remittance, which has happened, is 75,000. Rest of the transactions not going to impact the nostro account because they're all forward-looking in nature. Okay. So TT remittance 75,000. So your closing balance is 25,000. That means, so you had an opening balance of 1 lakh. You issued a TT, which is going to immediately hit your nostro account. Okay. And you have a closing balance. So now the bank says that you're required to maintain a credit balance of 25,000. Okay. So for that, what you have to do is, so you have to buy Swiss franc in spot market. Okay. So you will have a credit balance of 30,000. So since you have already a balance of, 25,000, so you need the balance to go up to 5,000 more to 30,000. So you have to buy, in the spot market so that you have more Swiss francs in your account. So this will maintain your account. So, but if you go to the, exchange position, so once you bought the Swiss francs, so now you see your, exchange position is exactly telling, but you want to have 10,000 overbought situation. So you're going to buy in a forward market Swiss francs on your own account. So which will make your balance overbought at 10,000. So the bank has to buy spot TT, okay, in Swiss francs to increase the balance to nostro account to 30,000. At the same time, to bring down the oversold position in Swiss franc nil. So this brings the position to nil, but you want the overbought position of 10,000. So you're going to buy Swiss francs in the forward market to make it overbought situation of 10,000. So this is this thing. Okay. So let me see if I have got any comments. So we do the last question of the day. Okay, so we are all understanding. That's great. So let's do the last question today before we sum up the whole transaction this thing. So XYZ bank Amsterdam wants to purchase 25 million against so many pounds. So there is a bank, XYZ Bank, which is in Amsterdam. They want to purchase 25 million rupees against pounds for funding their Nostro account. So they need to, fund their Nostro account, and they have a credited lower account with Bank of London. Okay. Calculate the amount of pounds credited. So they want to purchase, they want to purchase 25 million against. So they have 25 lakh rupees with them. Okay. And they want to convert them into pounds. So that's the mean. So the interbank rates are given to you for dollars. Okay. And then they are given in terms of pounds. So it's very simple. First, you convert into, so what we're going to do is basically we're going to use both the rates. Okay. So we have $1 is equal to 61.36 and 61.37. This is an American code. The second code is an European code, which is the price of £1 in terms of euro, in terms of dollars, which is the European. So we can just do a multiplication. Okay. And we'll arrive at the rate of pound in terms of rupees. Okay. So we'll get the rate as pound in terms of rupees. So 1 pound is equal to so many rupees we'll get after we multiply. But we want to, we want a rupee code. Okay. Because we have got 25, million rupees or 25 lakh rupees, and we want to convert them into pounds. So XY Bank wants to purchase 25 million against pound. So the ask rate will be applicable. So 25 lakhs into 0.0107. So that will be, 2,66,500 pounds. So they can purchase from 25 million of rupees. They can purchase pounds worth 2,66,000. So if you look at the question, so we have used the ask rate because now they're going to sell their rupee and convert them into pound. Okay. So we have chosen let me just see. Oh, sorry. We have used the ask rate because ask is there to buy. Okay. They have to, buy pounds. Okay. Fine. So, so this much. Okay. Fine. So let me just again sum up for you all. So, the bank has 25 million. So they want to, convert into pounds so that it can be deposited into Nostro account. So the two quotes are given to you. Okay. Fine. So, so if you use both the quotes, one is for buying, dollars in terms of rupees, another is for buying pounds in terms of dollars. But actually, we want to buy, pounds, which should be in terms of rupees. So we need a pound versus rupee quote. Okay. So what we do is that we convert that. So, so one is American, another European. So we put it in a formula, and we know that we get a rupee versus pound rate. So 1 pound is equal to so many rupees we'll get after we apply this formula. So we will get this rate. So 1 pound is equal to so and so. So if you look at the bid and ask, so this is, 1 pound will be, you have to shell out 93 rupees 7 paisa for 1 pound. But actually, you want it into be rupee code. Okay. So since you have 25 lakh rupees, you want to convert that into pounds. So you need to, buy pounds. Okay. When you have to buy pounds, so your rate will be 0.0107. So if you multiply that with 0.0107, so that means now you can deposit this much of money in your Nostro account. So calculate the amount of pounds to be credited to your Nostro account. So that's all. So that finishes our lectures. So Ashish, are you there?
Yes, sir, I'm there. Am I audible?
You are audible. Absolutely audible.
1 second, sir. 1 second. 1 second.
So I'm just going to stop the share so that we can.
Yeah. 1 second.
So we have covered all the topics, yeah, Ashish?
Yeah. Now, students, Parvesh sir has covered the topic of foreign exchange exposure and risk management. Basically, this chapter number is 10 in your new scheme. Now, with this, we come to the end of this topic. Now, overall, the session was, I have watched the session. It was very good. So, but sometimes some doubt may rise. Of course, I am also watching the same. But student, I just want to draw your attention to one or two points. Normally, where students, I have watched the queries. There was one student is asking, sir, regarding the adjustment of exchange rate margin. Okay, student. Now, in this context, please note that whenever there is any early cancellation or some kind of you can say early cancellation or early delivery is there. So in that case, what happened? Bank actually has to do the actual selling or purchasing. Okay, what they have to do, they have to do actual selling or purchase, because suppose if you are an exporter, okay, now you have to make the delivery after 3 months. Now after 2 months you come to the banker and ask him that, sir, please buy the dollar from me, because just 1 month before I have received the delivery. Of course bank will buy from it you, but ultimately he will or she will have to, banker will have to sell it in the market. Now in that case there will be an adjustment of the exchange rate margin. Okay, so if it has been given margin, exchange rate margin adjustment will be made there if it has been given in the question. Now regarding swap loss or interest on outlay, normally there are no adjustment are done, because these are only notional items. These are only notional items. So that's why normally there is another very genuine question rise among the minds of the student regarding exchange rate margin adjustment in, especially in calculation of cross rates. Okay, now suppose there is, I think there is one question. We have to buy or sell some Singapore dollar. Okay, Singapore dollar versus Indian rupees, we have to dollar. There are rupees oblique Singapore dollar we have to buy or sell. Now, in that case, if we are doing, say, purchase, we have to compute the cross rate. So then what happens? We have been provided rupees dollar rate, US dollar rate, and we have been provided Singapore dollar and this dollar rate. Now, in that case, it comes into the mind, and if exchange rate margin adjustment has been given to you, margin adjustment, so it comes into our mind whether we should adjust this margin in this dollar oblique rupee oblique dollar rate, or whatever the cross rate comes into the later on. So you can do either way. There is no problem. We consider both ways. There is not an issue on this. Okay, another there is a point in, there is common doubt is regarding rounding of decimal points. Now, student, if you see in the question or today's question, normally our rounding of was 0025, this multiple. Okay, this rounding off is as per FIDAI. This is as per the FIDAI guidelines. So please note that, student. Now, in that case, what happens? If FIDAI guidelines, it has been mentioned that please follow the FIDAI guidelines, then please use round it off your calculation to these multiples. Okay, otherwise you can continue with the same, because we consider both way. Even some student, despite the fact they have no, it has not been mentioned that you follow the FIDAI, even students follow this guideline, we consider the same because it is normally by default. However, so and sometimes if there is another question comes into the mind up to what decimal point. So see, students, if in the question you have to follow the instruction, first of all, very golden rule, follow the instructions if any has been given in the question. Otherwise, watch the rate given in the question. Say if they have used up to 2 decimal points only, then use it. Okay, if they have used 3 decimal point, then use the same. Okay, if they have followed the 4 decimal point, then this. So you have to see, we have to see that how much decimal point quotation have been given in the question, and you follow the same. Now, as our practice, student, in case if you have any query, please send it through mobile BOS app. Okay, of course, there are some lagging, for the 2 or 3 days lagging are there. There's some work are there. Another, if you have still you have an issue, please contact us. Okay. Now, while students are sending their queries through mobile BOS app, we have found one thing. Sometimes students give their not wrong correct contact number, because we are trying to sometimes we have, because from the exact nature of your query may not be understood from the language that you have mentioned. So normally in this case we contact the student over the telephone. So my request to you, please student, in a mobile app, please provide your contact number, the mobile number that we can contact you. It does not mean that you have to provide the contact number that is registered there. Even if you can write in your mail, sir, this is my contact number, please contact this. So we will contact you. Okay, student. Now with this, we come to the end of the session. Parvesh sir, thanks a lot for spending your precious time and enlightening the student on such a wonderful topic and a very interesting topic, because this topic is normally practically used when you will enter into the fields after the passing your CA. Now this is one of the area where normally CFS are supposed to have a lead, because now hedging, and as usual I have told you in all classes, these classes are basically meant for academic purpose only, and you are requested to not to indulge yourself into any speculative trading, because nowadays there are many websites are there that are claiming that we will trade into currency futures, etc. online. My request to you student, please don't indulge yourself into any such activities, because here our purpose only to guide you for the from the point of view of your examination. Okay, so that you can go through the you can come out, pass the examination and become the member. So student, now next, with this we come to the end of the session, and as usual, student, we have updated some, there is some changes around our schedule. So you are requested to, I think by the lunchtime, we will get updated revised, we will get hosted the revised schedule. Please go through the same and accordingly attend the classes for the topic. Thanks for patient listening and have a nice day. Thank you, sir. Thank you, Pravesh sir.
Okay, thank you so much. Thank you. Thank you.
Yes, sir.
Okay.
Okay, let me check any queries there, then I wind up the session. Okay, I think, sir, all queries have been taken up. So we can end the session. Thank you, sir.
Okay. Thank you.
Okay.
Thank you.